Hello champions, I hope you are doing really well. So this video is the final part of the Ultimate Marathon series for CA Inter DT. In this video, TDS, TCS and return of income, all the three will be covered in a very good detail. Every minute concept from these chapters you will find in these videos. So that's it guys, right after this intro, the TDS chapter begins and then TCS revision and then return of income. When it comes to TDS, I have not followed the same sequence in which the sections are arranged in the checkmate book. I've followed a different sequence. I've gone in the sequence of importance. So I finished the important sections first and then I've gone to the other sections. Okay, so you can start watching the TDS sections right after this. See, we are going to first start with section 194A. Now 194A talks about interest other than interest on securities. What does this mean? See, whatever interest transaction there may be, the interest may either be interest on securities or it may be other interest. Like for example, interest on securities, for example, debenture interest guys, or interest on government securities. So for this we have section 193. Okay, we are talking about other interest over here. Like for example, we have interest on loans, okay, then FD interest. So all other interests which are not relating to securities, all other interests, that will come under 194A. So right now my focus is 194A, which talks about interest other than interest on securities. Okay, now look at this entire diagram. Every section we will be having one diagram like this. This is 194A diagram. Okay, now let's talk about it from the basics. There's a person, Mr. Blue. This person, Mr. Blue, is giving interest to green. This is interest other than interest on securities. Okay, 1 second. So he's giving interest other than interest on securities. Now for green, this is income guys. For green, the source of the income is blue guys. So at source, tax will be deducted. So blue will become the deductor of tax and green will become the deductee of tax. Okay, so when will blue deduct tax? Blue will deduct tax at the time of payment or credit, whichever is earlier. Understanding? So point number 1, whenever blue is giving interest to green, interest other than interest on securities, for green it's an income. For green, source of the income is blue. At source, tax will be deducted. So blue will become the deductor of tax, green will become the deductee of tax. But when will blue deduct tax? At the time of payment or of interest, or at the time of passing the due entry. Credit means at the time of passing the due entry, whichever is earlier, blue will deduct tax. Okay, now listen to the next point. See, there's something called as the R hijack sections. R hijack sections. Total 6 sections we have here. These 6 sections guys will have a common point. That's why we put them under one group, because these 6 sections have a common point, so we've grouped them together. 194A is one of the R hijack sections guys. A for 194A. So in these 6 sections, the common point is these sections the TDS will apply only if the deductor fulfills this condition. We'll have to see who is a deductor. Is the deductor an individual or HUF, or is the deductor any other person? If the deductor is an individual or HUF, his preceding previous year turnover has to be more than 1 crore, or his preceding previous year gross receipt has to be more than 50 lakh. Repeat again with me. This is an R hijack section. In R hijack sections, we have a common point. The common point is applicable to whom? To the deductor. This section will apply only if the deductor fulfills one condition. Which condition? Either the deductor will be individual or HUF, or the deductor will be any other person. If he's an individual or HUF, then his preceding previous year turnover has to be more than 1 crore, or his preceding previous year gross receipt has to be more than 50 lakh. If he's any other person, then there's no condition. When will the condition apply? Only if the deductor happens to be individual or HUF. Okay. If it happens to be within 1 crore, or if it happens to be within 50 lakhs, then the section itself will not apply. Okay guys, this is also clear. Then comes the next point. Let's say the section is applicable. Let's say the deductor has to deduct tax. Now at what rate will he deduct tax? He is going to deduct tax at the rate of 10% guys. At the rate of 10% of the income. Okay. Now there's a limit. See, for small amounts, we will not ask the deductor to deduct tax. Only if the interest amount is more than the limit, then only we will ask him to deduct the tax. Now what is a limit? The limit will fully depend upon who the deductor is. The deductor can be a BCP, or deductor may not be BCP. Now who is BCP? I'll tell you, don't worry. BCP is nothing but 3 people guys. B for bank, okay, C for cooperative bank, and P for post office. Okay, so if the deductor happens to be BCP, then you will see who the deductee is. So your starting point is who is a deductor. If deductor is BCP or not BCP. If deductor is BCP, then you will see who the deductee is. Deductee can be senior citizen, super senior citizen, or may not be senior citizen, super senior citizen. If the deductee happens to be a senior citizen or a super senior citizen, then if the interest happens to be up to 1 lakh, no TDS. Only if it is more than 1 lakh, then only there will be TDS. Okay. So and guys, by the way, all these limits are new limits. Okay. The Finance Act 2025, which is applicable for your exams, has made tremendous changes, huge number of changes in the TDS and TCS chapter. So automatically this chapter becomes even more important for your exam, whether it is May 26, September 26 or Jan 27 exam. Because of the amendments, the TDS chapter becomes a little more important. These are all new limits, guys. Okay. So if the deductor is BCP, then I will see who the deductee is. If deductee is senior citizen or super senior citizen, then up to 1 lakh no TDS. If the interest is more than 1 lakh, then the deductor will deduct TDS at the rate of 10%. If the deductee is not BCP, the deductee is not senior citizen, super senior citizen, then the limit is 50,000. So up to 50,000 no TDS. If the interest is more than 50,000, then the deductor will deduct TDS at the rate of 10%. But if the deductor is not BCP itself, then the limit is 10,000. If the interest is more than 10,000, only then there will be TDS at the rate of 10%. I have written normal over here. These are normal limits. Why am I calling it normal limit? You will understand a little later only. Okay, that point you ignore for now. So this was your first TDS section, section 194A. It applies to what? Interest. What interest? Interest other than interest on securities. Then when do you deduct tax? At the time of payment or credit, whichever is earlier. Then is it an R high check section? Yes, it is an R high check section. So because it is an R high check section, we will trouble whom? We will trouble the deductor. If deductor is individual or HUF, then his preceding previous year turnover has to be more than 1 crore or his preceding previous year gross receipt has to be more than 50 lakhs. Then if the section is applicable, TDS rate is going to be 10%. Then the limit will depend upon who the deductor is. If deductor is BCP, then it will depend upon who the deductee is. If deductee is senior citizen or super senior citizen, 1 lakh limit. Any other person, then 50,000 limit. If deductor is not BCP, then 10,000 limit. Okay guys, now listen, this is the main part of the section. So in every section, we will have a diagram like this and then we will have some special points. So the first special point over here, if there's a motor vehicle accident and if the tribunal under the Motor Vehicles Act has awarded interest, okay, to be paid, then on that interest, the limit of 50,000 will apply. Which means if that interest is up to 50,000, then there will be no TDS. If that interest is more than 50,000, then same 10% TDS. So interest given by motor vehicles, interest given by motor accidents claim tribunal, these limits and all will not apply. Everything else remains the same. Only thing is these limits will not apply. We have separate limit altogether for this interest awarded by the tribunal. The limit is 50,000. Okay guys, then I already told you it's an R hijack section 194A guys. So therefore we will trouble the deductor. Then listen to the next point. See, BCP, that is your bank, cooperative bank and post office, they cannot be deductee under section 194A. What does this mean? Don't worry about the sentence. I'll straight away give you an example. I'll give you 2 examples, okay? In example number 1, BCP is giving me interest. Okay, so for me, it is income. And for me, source of income is BCP. So at source, tax will be deducted. So BCP will become the deductor of tax, guys. They will deduct the tax and they will give me the balance interest only. Now comes the second situation opposite. Now, I am giving interest to BCP. Like for example, let's say I borrowed a loan from the bank. Now I have to pay interest to the bank. So here also will I deduct tax? See, for BCP it is income. For BCP, the source of the income is me. So at source, if I deduct tax, okay, then I will become the deductor and BCP will become the deductee, guys. Now this is not allowed in 194A. See, the first situation is allowed, which means BCP can be a deductor. That is not a problem. That is allowed. BCP can be a deductor, but BCP cannot be deductee. Understanding? Which means if BCP has to pay interest to me, they will deduct tax and they will give me the balance interest. 194A will apply there. But if I have to give interest to BCP, then 194A will not apply. And this is a unique point only in 194A, not in other sections. In other sections, even BCP can be deductee. But in 194A, BCP can be deductor but cannot be deductee. Okay, you got the point, right? Then listen to the next point. CBS. CBS stands for Centralized Banking Solution. Okay, now there are 2 types of banking systems. One is centralized, which is called as CBS, and one is decentralized, which is nothing but not CBS. See, if the bank follows centralized banking system, what it means is all the branches, accounting and all is done together. It is centralized, okay? So if the bank is following CBS, if it's all centralized, then in that case, whatever calculations you will do for all the branches together. Okay, no confusion, no tension, I'll explain to you. Let's take one example. Let's say I have made 5 FDs with 5 different branches of HDFC. HDFC Chennai branch, HDFC Pune branch, HDFC Mangalore branch. Like that, in 5 branches of HDFC, I have made FD. Okay. Now, if HDFC Bank is following centralized banking, then they will see the total interest of all the branches put together. I am having FD interest in 5 branches. No. So, you will find the aggregate interest of all the 5 branches put together. If the aggregate interest is more than the limit, then the bank will deduct tax. So, if the bank is following centralized, then you don't treat the branches as separate. No. Treat the entire bank as one single unit. So, all the branches put together, whatever interest they have to pay me, single calculation they will do. Okay. But however, if the bank is not following CBS, which means if it is decentralized, then in that case, each branch has to be treated as a separate unit altogether. The Chennai branch alone will calculate and see how much TDS they have to deduct. Let's say the Andheri branch alone will do separate calculation. So if the bank is following CBS, then in that case, you will do calculations for all the branches aggregate. You will do a calculation for all the branches together. You will treat all the branches, the whole bank, as one single unit. Getting my point, guys? But however, remember, if the bank is not following CBS, then you should do calculation for each branch separately. That's all, guys, simple. Then comes my last special point. There are some situations over here. You have to tell me whether in these situations 194A TDS will apply or not. See, FD interest. When BCP is giving me FD interest, they will deduct tax, guys. BCP can be deductor, remember? BCP cannot be deductee, but BCP can be deductor. So when the BCP is giving me FD interest, BCP will deduct tax. On FD interest, TDS will apply. Similarly, RD interest, recurring deposit interest, on that also 194A TDS will apply. But however, savings account interest, guys, 194A TDS will not apply. Okay, so these are the 3 relating to BCP. All the 3, if you see, in all the 3, BCP is paying me interest. Even FD interest, even RD interest, even savings account interest, in all the 3, BCP is the one who's paying the interest. So for me, it is income. For me, the source of the income is BCP. So therefore, at source tax is to be deducted. So BCP will deduct tax. BCP can be deductor. But remember, FD interest and RD interest, 194A TDS will apply. But savings account interest, 194A TDS will not apply. Okay. Then interest paid by firm to partners. The partnership firm, the LLP firm, they pay interest to partners, right? Interest on capital, interest on loan and all. On that, 194A TDS will not apply. Then when assessee pays interest to BCP, this I already told you. When I pay interest to BCP, BCP is earning income. For BCP, the source of income is me. So at source, if I deduct tax, I will become the deductor and BCP will become the deductee. But BCP cannot be deductee. Right, guys? So when BCP gives me interest, they will deduct tax. But when I give interest to BCP, I will not deduct tax. 194A TDS will not apply. Okay. Similarly, when I have to pay interest to LIC or UTI, or if I have to pay interest to HUDCO, or if I have to pay interest to the insurance company, or if I have to pay interest to the income tax department, or if I have to pay interest to National Skill Development Fund, in all of these cases, guys, 194A TDS itself will not apply. Then when interest paid by assessee to NBFC, see, when I have to pay interest to NBFC, like for example Bajaj Finance, so when I have to pay interest to NBFC, I will deduct tax. See, listen to me, BCP cannot be deductee, but NBFC can be deductee. Then against Kisan Vikas Patra interest, there will be no TDS. NSC, National Savings Certificate interest, no TDS. NRE account, any interest if you get under NRE account also, no TDS. Okay, guys. Now listen, I'll ask you some questions. Tell me if this person can be deductor. Then tell me if this person can be deductee. Okay, simple. BCP. Can it be deductor, guys? Yes, it can deduct tax. Can BCP be deductee? No. Then NBFC. Can NBFC be a deductor? Yes. Can NBFC be a deductee? Yes. Now tell me the limits. This concept test is all about limit. First of all, entire 194A, what's a TDS rate, guys? Entire 194A TDS rate is 10% first of all. Then 3 limits we have. Tell me. If the deductor, the limit, by the way, the limit fully depends upon who's the deductor. If deductor is BCP, then it will depend upon who the deductee is. If deductee is senior citizen or super senior citizen, then the limit is 1 lakh. If the interest is more than 1 lakh, only then there will be TDS. Okay. Then if deductor is BCP, but if deductee is not a senior citizen or a super senior citizen, then the limit is 50,000. If the interest is more than 50,000, then only there will be TDS. Then, if motor accidents claim tribunal is awarding interest, here separate limit altogether we saw. The limit is 50,000. If it is more than 50,000, then only TDS. All other cases, which means if deductor is not BCP, then in that case 10,000 limit. If the interest is more than 10,000, then only TDS. Getting it, guys? Very simple. So the limit fully depends upon who the deductor is. If deductor is BCP, then it depends upon deductee senior citizen, super senior citizen or not. 1 lakh and 50,000, two limits we accordingly have. If deductor is not BCP, then one single limit of 10,000 we have. Okay guys, easy. Now we're going to start our second section, guys. Section 194C, which talks about payment to contractors. 194C, even this is going to be an R hijack section, right guys? So 194A, 194C, 2 R hijack sections will get done once we're done with 194C. Now here in 194C, guys, let's say there's a person, Mr. Green. He's a job worker, okay? So he is doing some job work service for Blue. Now Blue has to pay consideration for that service. So Blue is paying consideration. So don't you think over here Green is earning income from Blue, guys? So for Green, the source of income is Blue. So at source, Blue will deduct tax. Blue will become the deductor of tax, and Green, who is the job worker, he will become the deductee of tax. Okay, getting the point till here? So point number 1, we have Mr. Green, who's a job worker. He is rendering some job work service, some works contract service. What is works contract? We'll come to it, okay? Just take it for now as if he's rendering some works contract service, some job work he's doing for Mr. Blue, okay? So in return, of course, Blue will pay consideration for the service, guys. So this consideration becomes income for Mr. Green. So that income, the source is Mr. Blue. So at source, tax will be deducted. So Blue will become the deductor of tax and Green will become the deductee of tax, okay? Then this section is an R hijack section. Same thing, guys, because it's an R hijack section, we will trouble whom? We will trouble the deductor of tax. So if the deductor happens to be an individual or HUF, then his preceding previous year turnover has to be more than 1 crore or his preceding previous year gross receipt has to be more than 50 lakhs. Same thing, guys. If the deductor happens to be any other person, then there is no condition, no limit, nothing. The whole drama will apply of R hijack only if the deductor is individual or HUF. Now comes a limit. What is a limit? See, we have to look at there are two limits over here. Between Blue and Green, there might be multiple transactions during the year, guys. First, you will see the aggregate of all the transactions. If it is more than 1 lakh, TDS will apply. If it is not more than 1 lakh, then only you will come to the separate transaction, single transaction. Understanding? Always follow the sequence. First, aggregate. If the aggregate is more than 1 lakh, straight away you will enter into 194C. Only if the aggregate is not more than 1 lakh, then only you will look at each transaction separately. Whichever transaction separately is crossing 30,000, for that transaction alone, there will be 194C TDS. Okay, guys. Then now comes the next point, that when will you deduct tax? Even in section 194A, when did we deduct tax? At the time of payment or credit, whichever is earlier. Same thing even over here. Then in 194A, guys, we had straight away one rate of TDS, 10% we had. But 194C, the TDS rate will depend upon who the deductee is. In 194C, the TDS rate will depend upon who is the deductee. If the deductee happens to be individual or HUF, then 1% TDS rate. If deductee happens to be any other person, then 2% TDS rate. Okay. Now come on, guys, come to the smaller points, come to the special points now. I already told you about the limit. We will first check the aggregate limit. Only if the aggregate limit is not fulfilled, then only you will look at the separate limit. I've already told you this. Then listen, guys, in 194C, it should not be a personal transaction. Like for example, if I'm getting a job work done to polish my jewelry. Okay, let's say I have some jewels and I want to polish those, get those jewels polished. So now this is totally personal transaction, guys. It is not relating to my business. It is not relating to a profession. So yes, I'm going to a jeweler. Yes, I'm getting a job work done. Yes, it is a works contract service, but 194C will not apply, because it's a personal transaction. Understanding? So 194C will apply only if the transaction is relating to my business or profession. Like this personal expense point is there in 4 sections, guys. HIJC. Easy to remember, HIJC. In these 4 sections, If it's a personal transaction, that's all. That section will not apply. So 194C is a HIJC section. It's 194C, guys. So therefore, if it's a personal transaction, 194C will not apply. And it's an R hijack section that we have already concluded. Because it's an R hijack section, we have troubled the deductor by putting conditions on him. Now come on, guys. What is the meaning of works contract? A for advertising, B for broadcasting, telecasting, producing programs for broadcasting, telecasting, C for catering, C for carriage of goods or passengers, transportation of goods or passengers by any mode other than railways. Then one important point. This important point we will pay a little extra attention. Listen to me. So here what happens is, either I or my associate, one of us, we go to the contractor, we give him material and we also give specifications. I went to a job worker, I gave him the calculator and I also gave him instruction that I want my logo to be printed on each calculator. So I am giving him my material and I am also giving him my specifications, that is instructions. On that basis, he's going to do the work and he's going to return the calculators back to me. So this will also come under works contract. Now either I or my associate, any of us, can give the material and specifications. Now associate over here would be same as relative, which we had learnt in section 48 subsection 2 for our PGBP chapter. Okay, so but guys, don't get confused, don't misunderstand this whole thing. I'm not saying that works contract is only 5 things. I'm saying that these 5 things will also come under works contract. Okay guys, A for advertising, B for broadcasting, telecasting, producing programs for broadcasting and telecasting, catering, then carriage of goods and passengers by any modes other than railways, and then I or my associate, any of us are giving material and specifications. If I only give material, not works contract. If I only give specifications, not works contract. Material and specifications we're giving to the contractor, then only it will become a works contract. Okay guys. Then listen, I have some more examples of works contract. Even cold storage will come under works contract. Construction will come under works contract. Supplying labor, supplying staff, job charges, annual maintenance contract. Now you will ask that, ma'am, all of this is not in the definition. That's what I'm telling you. These definitions, we are giving only 5 examples. We are not saying that works contract is only these 5 things. Whatever we generally mean by works contract, like cold storage, construction, supplying labor and staff, job charges, annual maintenance contract, all these will anyways come under works contract. Okay guys, and then comes one last point. There is a special situation. In that special situation, there are 4 conditions. If all the 4 conditions are fulfilled, then 194C TDS will not apply. The special situation is connected to this carriage point, guys. See, very simple point, okay. Let's take one example. You'll easily understand. Imagine there are 2 people in the story, me and this person, Mr. Ram. Okay, now this person, Mr. Ram, he's in the transportation business, guys, which means he owns a lot of trucks, okay, and he does transportation of goods from one place to another place. Let's say I am in Bangalore and I want to send, let's say, a lot of goods I want to send from Bangalore to Chennai. So I come to Mr. Ram, I give him 10,000 rupees and I tell him, hey, listen, please do one small service for me. I have some goods. You have to transport these goods from Bangalore to Chennai, okay. So Mr. Ram is going to render one service to me, and that is by road. Through a truck, he is going to do the transportation of the goods for me from Bangalore to Chennai. First of all, do you agree this transaction will come under 194C? Yes guys, why? Because it is carriage, it is transportation of goods by road, so by any mode other than railways. So transportation of goods will come under 194C, guys. Now listen, if you look at this situation now, for Mr. Ram, 10,000 rupees is an income. And for Mr. Ram, the source of the income is me. So at source, I will deduct tax. So I will become the deductor of tax and Mr. Ram will become the deductee of tax. Right guys, now this is where the special situation is, guys. The special situation says 4 conditions. Condition number 1, the deductee Mr. Ram, he should be in the business of plying, hiring, leasing goods carriages, which means he must be in the trucks business, he must be a truck operator, okay. Condition number 2, he's a truck operator, right. He is going to own trucks, right. He should not own more than 10 trucks in a year. Maximum at any point of time in the year, the number of trucks that he owns should not be more than 10, okay. Third condition, the deductee Mr. Ram, he should some PAN or his Aadhaar, at least one he has to furnish. And point number 4, he also has to give a declaration saying all these conditions are fulfilled. So the truck operator, condition number 1, he is in the business of plying, hiring, leasing goods carriages. Condition number 2, he does not own more than 10 goods carriages at any point of time in the year. Condition number 3, PAN, Aadhaar, at least one he is furnishing. And point number 4, he gives us a declaration saying all the conditions are fulfilled. If all these conditions are fulfilled, then even though this is actually works contract, but still it is exempt under 194C, 194C TDS will not apply. Okay guys, that's all. Come on, answer one small concept test for me now. If assessee is giving specifications only to the contractor, will this become works contract, guys? You know this very well. This will not come under 194C, right? Because in 194C we learned we have to give material and specifications. So if I give only specifications, it will not be works contract. Okay, now come on. 3 TDS sections we're going to see back to back. 194D, 194G and 194H. All the 3 TDS sections over here, all the 3 of them are connected to commission, just different types of commission, okay? 194D talks about insurance commission, 194G will talk about lottery commission, and 194H will talk about all other commissions. Okay, so first of all, coming to section 194D, insurance commission. Here what happens is the insurance company is giving commission to insurance agent. See guys, the insurance agent will sell insurance policies. So every insurance policy they sell, insurance company will give insurance commission to the insurance agent. So on this insurance commission, 194D TDS will apply. So this insurance commission is an income for the insurance agent. And for the insurance agent, the source of this commission is the insurance company. So at source, the insurance company will deduct tax. So the insurance company will become the deductor of tax and the insurance agent will become the deductee of tax. Okay, so the deductor will deduct tax even over here at the time of payment or credit, whichever is earlier. Same thing we saw in all the sections till now. In 194A and in 194C, in both we saw that TDS will be deducted, payment or credit, whichever is earlier. Even over here, same thing. Okay, now the insurance can be any kind of insurance, guys. It can be life insurance, it can be vehicle insurance, it can be fire insurance, it can be any type of insurance. Any type of insurance, commission 194D will apply. Okay, the limit over here is 20,000, which means if the commission is up to 20,000, there will be no TDS. Only if the commission is more than 20,000, only then there will be TDS. Now, even over here, guys, same like 194C, the rate of TDS will depend upon who the deductee is. Even in 194C, the rate of TDS was depending on who the deductee is. Even in 194D, guys, the rate will depend upon who the deductee is. If deductee is company, then 10%. If deductee is any other person, then 2%. Okay, so be careful. All right, I'll do one small box for you over here. See, there are 2 sections where the rate of TDS depends upon who the deductee is. And the 2 sections are section 194C and section 194D. In section 194C, guys, if the deductee happens to be individual or HUF, then the TDS rate is 1%. If the deductee happens to be any other person, then the TDS rate is 2%. Okay. In 194D, if the deductee happens to be a company, then the TDS rate is 10%. And if the deductee happens to be any other person, then the TDS rate is 2%. Okay. Then comes 194G, guys, where we're talking about lottery commission. Here, let's say there's a person, he's conducting lottery, Mr. Blue. So he will hire some persons to sell lottery tickets in the market. Okay. So the person conducting lottery will give commission per ticket sold to the person selling the lottery tickets. Okay. So this lottery commission is income for Mr. Green, guys. And for Mr. Green, the source of this income is Mr. Blue. So at source, the tax will be deducted. So Blue will become the deductor of tax and Green will become the deductee of tax. Same like all sections, even over here, we will deduct tax at the time of payment or credit, whichever is earlier. See, in all the 3 sections, okay, the limit will be the same only. Even over here, if the commission is more than 20,000, only then there will be TDS at the rate of 2%. Same 20,000 limit. Here, there's only one TDS rate, 2%, guys. Okay, so 194D was insurance commission, 194G is lottery commission, then we have 194H. This is about all other commission. Now 194H, guys, this is an R hijack section. So therefore, we will trouble the deductor over here. If the deductor is an individual or HUF, same condition, his preceding previous year turnover has to be more than 1 crore or his preceding previous year gross receipt has to be more than 50 lakhs or he has to be any other person. Okay, so 194H will apply for all other commission. Basically, if it is not lottery commission, if it is not insurance commission, all other commission will come to 194H. So let's say principal is giving commission to the agent. For the agent, this is income. For the agent, the principal will be the source of income. So at source, the principal will deduct tax. So principal will become the deductor of tax and the person earning the commission income, the agent will become the deductee of tax. Same like all the sections, even over here, we will deduct tax at the time of payment or credit, whichever is earlier. Same thing, guys, same limit only. In 194DGH, in all the commission sections, same limit only. If it is more than 20,000, then only we will deduct TDS at what rate? At the rate of 2%. Okay guys, easy. Yes, 194D, insurance commission, 194G, lottery commission, 194H, all other commission. Okay, now listen to me. In 4 sections I told you, it should not be a personal transaction guys. 194H, even this is in these 4 sections. So over here, it should not be a personal expense. If it is a personal expense, 194H will not apply. And I already told you it's an R hijack section. Okay guys, now look at my concept test questions. 2 concept tests I have for you. In which section TDS rate depends on the deductee? 2 sections we have seen where the TDS rate depends on who the deductee is. One is section 194C and the other is section 194D. Very easy to remember guys, C and D. Right guys, the same black box which I had made for you over here, same thing. So in 194C and in 194D, the TDS rate will depend upon who is a deductee. In 194C, if deductee is individual or HUF, then the TDS rate will be 1%. If deductee is any other person, then 2%. In 194D, if deductee is a company, then 10%. But if deductee is any other person, then 2%. So easy to remember, C, D. In these 2 sections, the TDS rate will depend upon who is a deductee. Okay. Now we're going to do one small comparison of all the 3 commission sections. 3 commission sections we have, 194D, 194G and 194H. See, in all the 3 sections, what is common? In all the 3 sections, we deduct tax at the time of payment or credit, whichever is earlier. In all the 3 sections, the limit is the same guys. The commission has to be more than 20,000, only then there will be TDS. Okay, but what are the differences? 194D talks about insurance commission, 194G talks about lottery commission, 194H talks about all other commission. Then if you look at the TDS rate, in 194D, the TDS rate depends on who the deductee is. If deductee is a company, then the TDS rate is going to be 10% guys. But if deductee is any other person, then TDS rate is 2% guys. In 194G and 194H, only one TDS rate you have, and that is 2%. Life is simple over here. Okay. Then is it an R hijack section? See, 194D is not an R hijack section. 194G is also not an R hijack section. 194H is an R hijack section. Now we're starting off with the next section altogether. We're starting with section 194J. Now 194J covers 5 transactions guys. It covers professional fees, technical fees, royalty, non-compete fees and director's fees. Totally 5 things are covered in this one section. Okay, and 194J is also an R hijack section, of course guys. So in R hijack we have completed 194H, we have completed 194A and C, and now we are seeing 194J. Even this is an R hijack section, and hence of course we will trouble the deductor. We will say that the deductor, if he is an individual or HUF, then his preceding previous year turnover should be more than 1 crore or his gross receipt should be more than 50 lakhs. Okay, so the same thing that we learn in R hijack in all the other sections, that common point we have even over here. Now see, let's enter into the section. Let's enter into our main chart of 194J. There's this person, Mr. Blue over here. He is making a payment to Mr. Green. Payment of professional fees or technical fees or royalty or non-compete fees or director's fees. Now for Mr. Green, all of this is income guys. And for Mr. Green, the source of the income is Blue. So at source, tax will be deducted. So Blue will become the deductor of tax and Green will become the deductee of tax. Right guys? When will tax be deducted? Same like what we have learned in all the sections till now, tax will be deducted at the time of payment or credit, whichever is earlier. How many transactions are covered over here? 5 transactions: professional fees, technical fees, royalty, non-compete fees and director's fees. Okay. Now comes the next question, the limit and the rate of TDS. See, the limit is very unique in this section, okay? We have 5 categories of transactions, right? For each category, we have a separate limit. For each category, we have a separate limit of 50,000. So, in the entire year, between Blue and Green, professional fees alone will give 50,000 limit. If the professional fees is more than 50,000, then TDS will apply. Understanding? Similarly, technical fees, separate 50,000 limit. Royalties, separate 50,000 limit. Non-compete fees, separate 50,000 limit. But for director's fees, there will be no limit guys. Okay, so professional fees, technical fees, royalty, non-compete fees, for each of them we have a separate 50,000 limit, which means if the amount is more than 50,000, only then tax will be deducted at source, but for director's fees there is no limit at all. Okay, then what's the TDS rate over here? TDS rate is generally 10% over here. But however, in 3 places you will have 2% guys. See, generally the TDS rate is 10% only, but only in 3 places you will have 2%. Number 1, for technical fees, the TDS rate will be 2% always. Then if it is royalty, we will see it is royalty relating to what? If the royalty is relating to sale or distribution of movies, if it is relating to sale or distribution of cinematographic films, then it's going to be 2%, otherwise generally 10% only. Also, if the deductee is in the business of operating call center, then also the TDS rate will be 2%. So generally the TDS rate is 10% over here, but in 3 places I have 2%, guys. Number 1, technical fees. Number 2, royalty. Not all royalty, only that royalty which is relating to sale or distribution of movies. And then if the deductee, if he is in the business of operating call center, then the TDS will not be more than 2%. Understanding, guys? This was my main chart. Now come on, let's see the other special points of this section 194J. See, in 4 sections I told you that it should not be a personal transaction. HIJC. Here we have already learned 194C and now we're learning 194J. It should not be a personal transaction. Like, I'll give you one small example, okay? So I went to the doctor for a surgery. Now I have to pay him doctor's fees, which will be professional fees. But that's going to be a personal transaction, right? It is not relating to my business or profession, guys. 194J will not apply. Understanding, if it's a personal expense, 194J will not apply. Now even this is an R hijack section, I already told you. Limit, I told you we have separate 50,000 limit for each category, but for director's fees alone there is no limit, even this you know. Now listen, guys, extremely important point this next one is, if the deductor happens to be individual or HUF, and if the transaction is royalty or non-compete fees, we have 5 transactions over here, right? If the transaction is royalty or non-compete fees, and if the deductor happens to be individual or HUF, then this section itself will not apply. Are you getting it? This is a special situation, a unique situation. If the deductor happens to be individual or HUF, and if the transaction happens to be royalty or non-compete fees, then 194J itself will not apply. Alright, guys, then listen, here profession means specified profession under 44AA, this we already know, but there are some extra professions also, guys, which are covered in 194J under the term professional, like all sports related professionals like coach, umpire, trainer, commentator, physician, the sports person, the referee, the event manager, the anchor. All of these will also be considered as professional for the purpose of 194J. So when we say 194J, professional is not only specified professional under 44AA, but we will also include all these sports related professionals. But however, remember, teacher, sculptor and painter, they are excluded. They will be excluded from the word professional under 194J. Okay, teacher, sculptor and painter. 3 things excluded from 194J. Then comes another very important point, director's fees. See, the director is going to get remuneration from the company, right? Sometimes it's called director's fees. Sometimes you use the word remuneration. Sometimes you call it sitting fees. Sometimes you call it salary. Sometimes you call it commission. Doesn't matter what name you give to the director's fees. Whatever remuneration the director gets from the company, doesn't matter which category it comes under, the director's remuneration, guys, there are 2 TDS sections which will apply to director's remuneration. One is section 192, which you haven't learned right now, and the other is 194J, which we're learning right now. So listen, section 192 will apply if there's an employer-employee relationship between the director and the company. Because see, if there's employer-employee relationship, then that remuneration is nothing but salary, guys. Yes, and section 192 is the section which applies on salary. TDS on salary, section 192. So even if we call it director's fees, but if there is an employer-employee relationship between the director and the company, then even though we're calling it director's fees, remuneration, whatever we're calling it, it's a salary. And TDS on salary is covered by section 192. Okay, but if there is no employer-employee relationship, then in that case, we can't call the remuneration a salary, guys. In that case, the director's fees will come under 194J. Okay, this is an important point. Then some other points, a cameraman is also considered as a professional. Section 44AA, guys, the list of specified professional covers cameraman also. So therefore, if I pay any remuneration to the cameraman, it will become professional fees, 194J will apply. Okay, this is one point. Then there's one more case over here about TPA. TPA stands for third party administrator. I'll write it for you over here. TPA stands for third party administrator. So this is in connection to a medical insurance claim, guys. There's a patient, listen carefully, there's a patient, the patient goes to the hospital for medical treatment. So whatever is a medical bill between the hospital and the patient, the medical bill I will not pay. Why? I have a medical insurance policy. So therefore, the medical insurance company, they will settle the hospital bill on my behalf. That's the whole point of medical insurance. Now here what happens is the medical insurance company does not directly deal with hospitals, guys. Instead, they have intermediaries in between. These intermediaries are called as third party administrators. Okay, so whenever a person goes to the hospital, gets medical treatment done, and if this person is having, let's say, a medical insurance policy, then the third party administrator, he will directly make the payment to the hospital. The patient does not have to make the payment of the hospital bill. The third party administrator on behalf of the medical insurance company will directly make the payment to the hospital. Okay. Now, when the third party administrator is making payment to the hospital, on this payment, guys, section 194J will apply. Why? Because third party administrator is making payment to hospital, to the doctor, to the professional, to the specified professional. It will become professional fees. Okay, so basically just what we're learning over here is whenever third party administrator makes payment to the hospital to settle medical insurance claims, that payment will be considered as professional fees and hence 194J will apply. That's all, guys. Simple, straightforward concept. Yes. So this is it about 194J. Easy section, but a very important section. Now, come on, let's come to 194I, our next section in our entire TDS learning. Section 194I is TDS on rent. Very important section because again, this is an R hijack section. So under your R hijack sections, you know about 194H, TDS on other commission. You know about 194J, professional fees, director's fees, technical fees, royalty, non-compete fees. You know about 194A, interest other than interest on securities. You know about 194C, payment to contractors. And now you're going to be learning 194I. 194I talks about TDS on rent. Let us do our main diagram first. See, in 194I, because it's an R hijack section, of course we will trouble the deductor. The deductor, if he's an individual or HUF, his preceding previous year turnover has to be more than 1 crore or his preceding previous year gross receipt has to be more than 50 lakhs as a case may be. If he's any other person, then we will not trouble him. But if he's an individual or HUF, then this condition has to be fulfilled. Only then 194I will apply. This is the common point in all your R hijack sections, guys. Now, there's a tenant, let's say this person, Mr. Blue, he is paying rent to Mr. Green. Now, for Green, it's an income, and for Green, Blue is a source of income. So, at source, tax will be deducted. So, obviously, Blue will become the deductor of tax, and Green will become the deductee of tax. Okay. When will tax be deducted? Same like what we have learned in all the sections till now. Tax will be deducted at the time of payment or credit, whichever is earlier. Okay. Now, at what rate will tax be deducted? That depends on the rent is relating to what. If the rent is relating to land or building, then 10% TDS will apply. If the rent is relating to furniture or fixtures, here also 10% TDS will apply. But if the rent is relating to plant and machinery, then only 2% TDS will apply. So, this itself tells you that section 194I covers 3 types of rent. It covers rent relating to land and building, rent relating to furniture and fixtures, and also rent relating to plant and machinery. Okay, guys. Then the person to whom we are giving the rental income, the landlord basically, the deductee basically, in our example, Mr. Green, this person, he may be owning the property, he may be owning the asset, he may not be owning the asset, it doesn't matter. This itself means even sublease cases will get covered, guys, by 194I, because whether the person to whom you are paying rent, whether he owns the asset or not, that is irrelevant. We are paying rent. Rent means welcome to 194I. That's all. Okay, everybody. Yes, and what's the limit over here? We will look at the per month rent. If the per month rent is more than 50,000, then 194I TDS will apply. Got it? This is our main section. Now, come on, let's see the remaining points. Only 3 more points, guys. See, can it be personal rent also? Like if I'm paying rent for my house, will that also get covered under 194I? No, guys. HIJC. In these 4 sections, it should not be personal transaction, and 194I is one of them. So in 194I, if it's a personal transaction, then 194I will not apply. Okay. Then I already told you it is R hijack section. Now look at this next point over here, guys. Lump sum rent, one-time deposit, upfront premium, lease charges, on all this also will 194I apply. They all mean the same thing. I'll give you one example. You must have seen this, right? Whenever we take a house on rent, we give a security deposit to the landlord, guys. We give like 6 months deposit in some places, 3 months rent deposit in some places. So we give a lump sum deposit to the landlord. Now, is that lump sum deposit, is that security deposit also going to be considered as rent? On the deposit also, should we deduct tax or not? It depends. It depends on whether that deposit is going to be refundable or if it is not refundable. See, if it is refundable, then it is not rent, isn't it, guys? Because I'm going to get my money back. So it is not rent. So if it is not rent, then no 194I TDS. But however, if it is not refundable, then don't you think it is actually nothing but rent only? It is just lump sum rent, guys. If it is not refundable, then it is rent, and if it is rent, 194I will apply. So on the deposits, on the lump sum deposits, whether you call it one-time deposit, whether you call it upfront premium, whether you call it lease charges, whatever name you want to give it, if it is refundable, then it is not rent. If it is not rent, then no TDS. But if it is not refundable, then it is going to be rent. It is definitely rent because it is not refundable. Then 194I TDS will apply. Alright everybody, that's it. This is your main section, section 194I along with the special points. Now listen to one more section, guys, 194IB. We learned 194I and now it is 194IB. Even this is relating to rent to which 194I is not applicable. If 194I is not applicable, then only we come to section 194IB. Okay guys. Now see, in section 194IB, our style of learning will be slightly different, okay. Basically what happens is there are 4 sections. Section 194IB, section 194M, section 194DA and section 192A. All the 4 sections we have not learned till now. In these 4 sections, there's a lot of scope for silly mistake. So that is why in these 4 sections alone, our style of learning will be a little different. We will have something called as checkpoint, okay? Like over here, we have 4 checkpoints in 194IB. Only if all the 4 conditions are fulfilled, only then this section will apply. So thinking will be very easy for us in these 4 sections. So for section 194IB, look at the checkpoints. First checkpoint is that the deductor has to be individual or HUF. We did not have this point in any other section in the past, guys. We did not even talk about who the deductor is. But here the deductor has to be individual or HUF. If the deductor is any other person, this section itself will not apply. Okay, condition number 1, checkpoint number 1. Checkpoint number 2, I already told you. When will you come to 194IB? If it is rent and 194I is not applicable, then only you will come to 194IB. Checkpoint 2, guys. Then comes your checkpoint 3. Why is 194I not applicable? If it is rent, 194I should apply. No. Why is 194I not applicable? What's the reason? That's the third condition. The reason is either it's a personal transaction. That is why 194I is not applying. Because see, guys, HIJC, 194I. It's HIJC section. In these 4 sections, it should not be a personal transaction. So maybe it is personal rent and maybe that is why 194I is not applying. Or maybe 194I is an R hijack section, guys. So because it's an R hijack section, the deductor has to fulfill conditions preceding previous year turnover, preceding previous year gross receipt and all. Maybe that condition is not fulfilled. So my third checkpoint is, why is 194I not applicable? Either it is not applicable because it's a personal transaction, or it is not applicable because the preceding previous turnover and the gross receipt criteria is not fulfilled. 194I will apply only if turnover is more than 1 crore. Gross receipt is more than 50 lakhs. But what if it is within 1 crore? What if it is within 50 lakhs? 194I will not apply. Then come to 194IB. That's my third checkpoint. Condition 4C, in 194I, how many types of rent we are talking about? 3 types of rent, no. Rent for land and building, plant and machinery, furniture and fixtures. But in 194IB, guys, we are talking only about rent relating to land and building. Not furniture, fixtures, not plant and machinery. So 4 checkpoints. If all the 4 checkpoints are fulfilled, then only you will enter into 194IB. Okay guys, so in 194IB, yes, even here I am talking about rent, but I am talking about that rent which is not covered by 194I. Okay, here the deductor has to be individual or HUF. Even over here we deduct tax at the time of payment or credit, whichever is earlier. But here we don't cover rent on furniture and fixtures, plant and machinery. We only cover rent on land and building. And when do we come to 194IB? Only 194I is not applicable. Why is 194I not applicable? There can be multiple reasons, but only for 2 reasons we will come to 194IB. Reason number 1, 194I is not applicable maybe because it is personal rent and that is why 194I is not applicable, or maybe because the preceding previous turnover gross receipt criteria is not fulfilled. Only because of these 2 reasons only, if 194I is not applicable, then only you will come to 194IB. Okay guys, now what's the TDS rate over here? TDS rate is simple, 2% guys, 2% TDS rate. But what's the limit now? The limit is more than 50,000. Same like 194I. Even in 194I, the monthly rent has to be more than 50,000. Same thing even over here, guys. The monthly rent has to be more than 50,000. So limit is the same in both. In 194I also, 194IB also. In both, limit is the same. Monthly rent, not aggregate. Monthly rent has to be more than 50,000. Okay. Now comes the last point, the most unique point in 194IB, which you will not find in any other section. Here, we deduct TDS when? We deduct TDS in the March month or in the last month of tenancy. Like for example, let's say the tenant vacated the property in December. So December will become the last month, guys. In December month, we will deduct the tax. Or let's say he's not vacating the property. Then the last month will be March month, guys. In March month, we will deduct tax. So either we will deduct tax in the last month of tenancy if he's vacating, or otherwise we will deduct tax in the March month itself. So every month and all, we will not deduct tax in 194IB. We deduct tax for the entire year at the end of the year only. Okay, guys. So with this, we have learned both the sections relating to rent, 194I and 194IB. Okay. Now listen everybody, something very interesting. If it is rent, you will always first try 194I. If 194I is not applicable, then you will come to 194IB, guys. Similarly, we have one more section. See, if it is works contract, you will first try 194C. Or let's say if it is other commission, not lottery commission, not insurance commission, you will first try section 194H. Similarly, if it is professional fees, I'm not talking about technical fees, only professional fees, you will first try section 194J. But these three sections, guys, if they are not applicable, then you will come to section 194M. Understanding? That is why we often say that 194IB and 194M are close cousins, very similar logic. If 194I is not applicable, then only we come to 194IB. Similarly, if 194CHJ is not applicable, then only we come to 194M. Are you all following? Simple concept, guys. So just like how I gave you 4 checkpoints in 194IB, in 194M I will give you 3 checkpoints. Once you know 194IB, 194M will be one cakewalk only, guys. Listen to me. Let me straight away take you to the checkpoints. Then we will come to the main diagram, guys. First checkpoint, same guys, the deductor has to be individual or HUF. Same point we had in 194IB also. Then comes the second condition that 194C, HJ are not applicable. Same thing. Why is 194C, HJ not applicable? Same reason, guys. Either it's a personal transaction or because preceding previous turnover gross receipt criteria is not fulfilled. So only if 194C, HJ is not applicable because any of these 2 reasons, only then you come to 194M. Getting it? Are you all following? So in 194M, before you can even apply 194M, you will always check these 4 conditions. Tell me the 3 conditions, 3 conditions, 3 checkpoints. So what are the 3 checkpoints? Checkpoint number 1, the deductor has to be individual or HUF. Checkpoint number 2, 194C, HJ are not applicable. Checkpoint number 3, why? Why is 194C, HJ not applicable? Either because it's a personal transaction, that's why, or maybe because preceding previous turnover gross receipt is not being fulfilled. Okay, guys, only if 194C, HJ is not applicable because of any of these 2 reasons, only then we come to 194M. Now, once you enter into 194M, same thing, you will look at, even over here, you will deduct tax at the time of payment or credit, whichever is earlier. Then here the limit, you will look at the aggregate limit of the entire year put together. If it is more than 50 lakhs, then only we will deduct tax at the rate of 2%. Okay, all these other points I've spoken to you in the checkpoints itself. So in section 194M, the limit is 50 lakhs, aggregate limit for the entire year. If it is more than 50 lakhs, then we will have TDS at the rate of 2%. Answer one small concept test. Does section 194M apply to the following? Will it apply to technical fees also? No, guys. Here itself I told you, only professional fees. If 194J is not applicable, you will come to 194M. In 194J, there's technical fees, royalty, non-compete fee, all that will not come to 194M. Only professional fees, guys. So will technical fees come to 194M? No. Will lottery commission come to 194M? No, only other commission. So technical fees will stay under 194J only. Lottery commission will stay under 194G only. All this will not come under 194M. What will come under 194M? Works contract. Other commission, professional fees, only this will come under 194M. Understanding, guys? Yes, so that's it. We'll first start with section 194DA, which talks about life insurance maturity proceeds. Now, this section will not be very difficult for us because we have already learned about life insurance maturity proceeds so well in our IFOS chapter. Remember, guys, in our IFOS discussion, we had learned about the 4 situations. We had learned about term life insurance policy, death, KMIP, premium is within the limit, more than the limit, 1st April 2023. So we've already learned a lot of things about life insurance maturity proceeds. So with that knowledge in our mind, 194DA is going to be a very simple section for us. Over here, what's happening is there's a life insurance company on one side and another person, let's say Mr. Green, on the other side. Now, between these two, there's a life insurance contract, okay, between the life insurance company and the deductee. Let's say there's a life insurance contract. Now what happened is this life insurance company has given maturity proceeds to the deductee. Okay, now these maturity proceeds are going to be an income for this person receiving this money, guys. So therefore, and the source of this income will be the life insurance company. So at source, tax will be deducted. So the life insurance company will become the deductor of tax and the person who is receiving the maturity proceeds will become the deductee of tax. Okay, now see something very unique in this section. All the sections till now that we have seen, we deducted tax at the time of payment or credit, whichever is earlier. But in 194DA, here we deduct tax at the time of payment, something very unique in this section. So till here, what are the points you know in this section? Point number 1, we're talking about life insurance maturity proceeds. Point number 2, we deduct tax at the time of payment over here. Okay, but listen, guys. Every time maturity proceeds transaction is there, this section will not apply. Because we know life insurance maturity proceeds is generally exempt under 1010D, guys. So if this maturity proceeds itself is an exempt income, then there will be no TDS. Only when this maturity proceeds is going to be taxable, only then there will be TDS. Now, what are the situations when this maturity proceeds is taxable? That we have already covered in our IFOS chapter, guys. I'll give you a quick reminder. 4 situations I had given you in IFOS chapter. Situation number 1, the policy is not term life insurance policy. It is not KMIP. Also, money is not received upon death. But however, the premium happens to be, the life insurance premium happens to be more than the limit. Then if both these conditions are fulfilled, then the maturity proceeds will become taxable. Then second situation, same thing, it is not term life insurance policy. It is not keyman insurance policy. Also, money is not received upon death. And this time, the premium is within the limit. But however, the policy is taken on or after 1st April 2023. Then all these policies put together, if the aggregate premium happens to be within 5 lakhs, then the maturity proceeds will be exempt. But those policies, because of which the aggregate premium is crossing 5 lakhs, those policies, the maturity proceeds will become taxable. Do you remember, guys? Then number 3, keyman insurance policy will always be a taxable policy. Also, sometimes we have section 80DD policy, that is also going to be a taxable policy. Do you recall, guys? So if this maturity proceeds happens to be exempt under 1010D, then TDS under 194DA will not apply. Only if these maturity proceeds are taxable under IFOS, that is in these 4 cases, then only 194DA will apply. Okay, guys. Now if 194DA is applicable, what's our limit? The limit is 1 lakh. If the maturity proceed happens to be less than 1 lakh, no TDS. If it happens to be equal to 1 lakh or if it is more than 1 lakh, then there will be TDS. So these two are the most special points of 194DA, guys, that here we deduct tax at the time of payment and here the limit is abnormal limit, which means if the maturity proceeds happen to be more than or equal to 1 lakh, there will be TDS. And if there is TDS, if the limit is if the amount is more than the limit, if TDS is applicable, TDS will be at the rate of 2%. Okay, guys, but there's one more special point in this section, guys. 2% of what? 2% of the net amount. What is the net amount? Basically, it is not 2% of this maturity proceeds. No, it is 2% of net amount. Net amount is nothing but whatever maturity proceeds we are receiving now, that minus all these years whatever life insurance premium we had paid. So whatever is this net number, on this net number only 2% TDS will apply. Okay, guys, now listen to me. Until now, if you remember, I have given you checkpoints in how many sections? I have given you checkpoints in 2 sections only. In 194IB, I had given you 4 checkpoints. Then in 194M, I had given you 3 checkpoints. Now guys, in 194DA, in this section also I am going to give you checkpoints. There will be 2 checkpoints. In simple words, whenever you identify it is 194DA, your usual process you will not apply. You will straight away come to the checkpoints. What are the checkpoints? Checkpoint number 1, it has to be a taxable policy, which means it has to be one of these 4. Because if the maturity proceeds are exempt, guys, then no TDS itself. So first of all, the maturity proceeds have to be taxable. It has to be a taxable policy. Second condition, second checkpoint, the maturity proceeds have to be at least 1 lakh. If both these conditions are fulfilled, if both these checkpoints are fulfilled, then only you will enter into 194 DA. Are you understanding, everybody? Yes. So in 194 DA, come on guys, that's all. That's it about the section. Let's see if you're able to answer both my concept tests. Concept test number 1. Whether the net amount, what is net amount? Maturity proceeds minus premium paid. Whether the net amount is at least 1 lakh or not. Is that relevant or irrelevant? The net amount, guys, the net amount, whether this is at least 1 lakh or not, I don't care. What has to be at least 1 lakh? The maturity proceeds have to be at least 1 lakh. So net amount, whether that is at least 1 lakh or not, is irrelevant. The maturity proceeds, is that 1 lakh or not, that is relevant. It is a maturity proceeds which have to be at least 1 lakh. Then come to my second concept test over here. Life insurance policy I took 3 years back. The annual premium is 30,000 rupees. Maturity proceeds is 1,20,000 rupees. Now what is the net amount? Net amount is nothing but, what's the formula I told you? Net amount is nothing but whatever is your maturity proceeds, this minus your premium, guys. So what is the maturity proceed over here? 1,20,000. What is the premium, guys? 30,000. So my net amount is 90,000. Terrible. Life is not that easy also. See, when I say premium over here, I am talking about the aggregate premium. All the years put together, not 1 year premium. The policy was taken 3 years back. So 3 years I would have paid premium. 30,000 per year for 3 years. This will be the aggregate premium. Understanding? So 1,20,000 minus 90,000, 30,000. This is going to become your net amount. What this teaches you is that when you're calculating net amount, be careful. It is not maturity proceeds minus 1 year premium. No, it is maturity proceeds minus aggregate premium. Now you understood the significance of the word aggregate. It's not annual premium. It is aggregate premium. Okay, this was your 194 DA, guys. Now come to the next section, guys, section 192A, which talks about RPF withdrawal. See, you must have learned about RPF withdrawal a little bit in your salaries chapter. There you would have learned that when you withdraw money from RPF, sometimes it is exempt and sometimes it is taxable. Right, guys? Whenever you withdraw money from RPF, generally it is taxable, but sometimes it is exempt also. So on that withdrawal, we have TDS, and that is section 192A TDS. Let's talk about it slowly, step by step. So let's say there's RPF on one side and there's an employee on the other side. Employee is withdrawing the money from RPF. So when the employee withdraws money from RPF, it's an income for the employee, guys. And for the employee, the source of the income is RPF. So at source, tax will be deducted. So RPF will become the deductor of tax and my employee will become the deductee of tax. Okay, guys. Then all the sections till now, we were deducting tax at the time of payment or credit, whichever is earlier. Only 194DA, the last section, that only we deducted tax at the time of payment. 192A, here also we will deduct tax at the time of payment, guys. Now listen to me. What are the sections where we will deduct tax at the time of payment? We have some 6 to 7 sections. The hint for you to remember will be land dab 2, 4. That is 194LA, 194N, 194DA, 194B. Now in 194B we have 2 sections, 194B and 194BB. Then we will have 2 sections in the 192 series, and that is 192 and 192A, and then 194. So land dab 2, 4. 1, 2, 3, 4, 5, 6, 7, 8. So in these 8 sections only we will deduct tax at the time of payment. All the other sections we will deduct tax at the time of payment or credit, whichever is earlier. Understanding? Come back now. So in 192A we're talking about RPF withdrawal. So when you withdraw the amount from your RPF at the time of payment, that is at the time of withdrawal, the RPF will deduct tax. Okay, they will deduct tax at what rate? They will deduct tax at the rate of 10% if the withdrawal happens to be at least 50,000. So even this is an abnormal limit. Until now only one abnormal limit we saw, which is 194DA, the last section. Even in 192A, here also the limit is abnormal limit, which means if the amount is less than 50,000, no TDS. If it is more than or equal to 50,000, then only you will have TDS. Okay, and TDS rate is 10%. When you withdraw money from RPF, it is generally taxable, but there are some situations where it is exempt. If your withdrawal is exempt, then of course 192A TDS will not apply. So I have only one checkpoint in 192A, and that is the withdrawal has to be taxable, only then the section will apply. So if the withdrawal is taxable, then you will look at the amount case. If the amount is equal or more than 50,000, then 192A TDS at the rate of 10% will apply at the time of payment. Okay. Now see, generally the withdrawal is taxable, but there are 4 situations where the withdrawal is exempt. What are the 4 situations? Situation number 1. See, if the employee has rendered continuous service of 5 years, which means if the employee has worked for one employer for 5 years continuously, thereafter only if he is withdrawing money from RPF, then the amount withdrawn will be fully exempt. Okay. So continuously employee has worked for 5 years. Then comes the second situation. In the second situation, employee has worked for less than 5 years. Employer 1, for example, worked for 4 years only. Employer 2 worked for 3 years only, for example. But however, in employer 1, RPF was applicable. When the assessee left employer 1 and joined employer 2, the RPF balance assessee did not withdraw. Instead, whatever was the RPF balance here under employer 1, the same amount got transferred to RPF under employer 2. So therefore, even though assessee has actually changed jobs, money has stayed inside RPF only, guys. From one employer to another employer, but money has stayed inside RPF only. So RPF point of view, if you see 4 years plus 3 years, you have rendered service of 7 years, which is at least 5 years. So now when you withdraw the money, the withdrawal will be fully exempt. Understanding? So either you should have rendered continuous service of 5 years to one employer, or even if you're shifting jobs, your money has to stay inside RPF for at least 5 years. Then whenever you withdraw later, it will be fully exempt for you. Then comes your third situation. Yes, I rendered service less than 5 years. Yes, I did not work for 5 years, but why? Why did you leave in less than 5 years? What was your reason? The reason was something which is beyond the employee's control. Like for example, I want to work for 5 years, but what can I do? Employer itself is shutting down his business. So even if I want to work for 5 years, how can I work? Employer itself is closing his business, he's closing his shop. So even I have to leave the job. Understanding? So yes, I worked for less than 5 years, but it is beyond my control. The reason is beyond my control. Or let's say the employee fell sick, or employee is suffering from a disability. So in all these cases, yes, the employee worked for less than 5 years, but the reason was beyond his control. So in such cases, guys, even though he worked for less than 5 years, it's okay. When you withdraw the money from RPF, it will be exempt only for you. Okay. Then comes the fourth situation. Whatever money is there in RPF, you withdrew the money and you put it into NPS. Basically, you did not withdraw the money and take it home. No. Whatever money is there in RPF, you withdrew and you transferred it into NPS. Even in this case, the withdrawal will be exempt. Getting my point, guys? So in section 192A, RPF withdrawal, when you withdraw money from RPF, the first thing you have to check is the withdrawal exempt or taxable? Generally, it is taxable, but in these 4 cases, it is exempt. Now comes our next section, 194IA. So in 194IA, there are 2 people in the story. We have a buyer and we have a seller. The seller is selling his immovable property to the buyer. Okay. So what is happening is, because the seller is selling immovable property to the buyer, for the seller there will be capital gains because he's transferring immovable property. That capital gains, the source will be the buyer. So buyer will become the deductor of tax and the seller will become the deductee of tax. Okay. So what is happening over here? There's a transfer of immovable property. So whenever you transfer an immovable property, the buyer will deduct tax against you at the rate of 1%. Okay. Now listen to me. When will the buyer deduct tax? As usual, guys, payment or credit, whichever is earlier. Then listen to me. If this transfer of immovable property happens to be by way of compulsory acquisition, then I have a different section altogether, 194LA, that will apply. So that is why 194IA will apply only if the transfer is not by compulsory acquisition. Simple, guys, straightforward. Then listen, if the immovable property which I am transferring, if it happens to be a rural agricultural land, then it is not a capital asset. So there won't even be capital gains. So no question of 194IA. But however, if it happens to be urban agricultural land, it is a capital asset. There will be capital gains and hence 194IA will apply. Now comes a question, what is a limit? For the limit, you have to see the consideration for this transfer or stamp duty value, whichever is higher. Consideration or STV, whichever is higher you will take. That higher number, if it is at least 50 lakhs, again abnormal limit, guys. If it is at least 50 lakhs, then there will be TDS at the rate of 1%. So tell me, how many abnormal sections you have seen till now? You have seen 194DA, your life insurance maturity proceeds, your 192A, your RPF withdrawal, and now 194IA. As of now, only 3 sections we have seen which have abnormal limit. Okay, this is it about your 194IA, the main part, guys. Now see, we have some special points also. When we're talking about consideration over here, we will also consider the club membership fees. We will include that also. Then car parking fees, we will include that also. Water fees, lift fees. Basically, it's not just consideration for the property. We will also include all these charges also in the consideration we will include. Okay guys, then look at this table over here. You have to tell me in each of these cases whether 194IA will apply or not. If the immovable property being transferred is rural agricultural land, then 194IA will not apply. Why? If it is rural agricultural land, it is not a capital asset. If it is not a capital asset, no taxable capital gains, guys. So if income is not taxable, then no TDS. Urban agricultural land, it is a capital asset. There will be capital gains. So therefore, here 194IA will apply. Rural land is a capital asset. There will be capital gains. 194IA will apply. Urban land, even here 194IA will apply. Residential house property, this is also a capital asset. There will be taxable capital gains. 194IA will apply. So in simple words, 194IA will apply to transfer of all immovable properties except rural agricultural land. Okay guys, then comes one last point. Look at this very carefully, important. Okay, this point was brought in only by Finance Act 2024. So it becomes a little extra important. I sold a house for 80 lakh rupees to A and B. They are joint buyers, guys. So joint buyers, each of them will pay 40 lakh and 40 lakh, which is less than 50 lakhs. So will I apply the limit per seller, per buyer? Or will I check, okay, for this house, the amount is 80 lakhs, which is at least 50 lakhs. 194IA is applicable basically per property, not per seller, not per buyer. You will not see how much amount each buyer is paying, no. You will not see how much amount each seller is getting, no. You will just see what is the value of the property, 80 lakhs, which is at least 50 lakhs. That's all. Welcome to 194IA. Okay guys, this is section 194IA. Now come on guys, come to the next section, which is 194LA. This section talks about compulsory acquisition. So here on one side, let's say we have Mr. Green. He owns some immovable property. That immovable property got compulsorily acquired by the government. So which means compulsory acquisition, guys, is a transfer of capital asset. There will be capital gains for Green, guys. So therefore at source, the government will deduct tax. So the government will become the deductor of tax, and the person whose property is getting compulsorily acquired will become the deductee of tax. So remember, in 194IA, we are covering all modes of transfer except compulsory acquisition. Why? Because compulsory acquisition is covered in 194LA. So in 194LA, it should be only compulsory acquisition of immovable property. Only then this section will apply. Okay guys, now listen. Here what's a limit? The compensation which the government is going to give has to be more than 5 lakhs. If it is more than 5 lakhs, 10% TDS will apply. Then listen, over here, the tax will be deducted at the time of payment, guys. So at the time of payment, what are the sections? Tell me that hint once again. At the time of payment, your hint is land dab 24. That is 194LA, which we are learning now. Then 194N, which we haven't learned yet. Then 194DA, which we have learnt already. Then in 194B, you will have B and BB. Then 192 and 192A, you have already learnt about 192A. And then 194. Okay, so 194LA, here also we will deduct tax at the time of payment. Now listen. If the asset being compulsorily acquired happens to be rural agriculture land, here we know, guys, it is not a capital asset, hence no capital gains, hence no TDS. This we already know. But however, if it is urban agriculture land, guys, do you remember compulsory acquisition of urban agricultural land is going to be exempt under section 1037? Do you remember? See, urban agricultural land, it is a capital asset. But if urban agricultural land is being compulsorily acquired, then in that case, the capital gains will be exempt under 1037. So because capital gains are exempt, because income is not taxable, there will be no TDS. So in conclusion, in 194LA, if any agricultural land is being compulsorily acquired, whether rural, whether urban, there will be no TDS under 194LA. Come on everybody, let's move on to our next section now. Let's come to 194N. So in section 194N, point number 1, we are talking about cash withdrawals. Point number 2, when you withdraw cash from BCP, that is from bank, cooperative bank or post office, at the time of withdrawal, that is at the time of payment, tax will be deducted. Okay, at what rate will be deducted, what will be the limit applicable, all that depends upon are you a defaulter or are you not a defaulter. Defaulter means what? Defaulter means leave immediately preceding previous year, leave 24-25. See, 3 years before that. In the 3 years before that, in all the 3 years, you did not file ITR. You're a defaulter max. You did not even file ITR. Even 1 year if you file, you're not a defaulter. So defaulter means extreme level of default. In none of the 3 years you filed your ITR. Then only you become defaulter. So if you are not a defaulter, which means even 1 year if you have filed ITR, then up to 1 crore if you withdraw, no TDS. But if you withdraw more than 1 crore, then TDS will apply at the rate of 2% of excess. If the amount I'm withdrawing is more than 1 crore, like for example, if I'm withdrawing 1.10 crore, then only on the 0.10, only on the excess above 1 crore, on the excess only tax will be deducted. So if you are not a defaulter, up to 1 crore, no TDS. More than 1 crore, 2% TDS on the excess above 1 crore. But if you're a defaulter, up to 20 lakhs, no TDS. If you withdraw up to 20 lakhs, no TDS. If you withdraw more than 20 lakhs up to 1 crore, then whatever is the excess above 20 lakhs on that 2% TDS. And if you withdraw more than 1 crore, then whatever you're withdrawing above 1 crore on the excess, 5% TDS. So remember, in 194N, we have excess concept. TDS will be only on the excess. Okay, you don't have this anywhere else till now. You might have in 1 or 2 sections hereafter, but till now, this is the first section where we are seeing the TDS will be deducted on the excess. Okay, then listen. The person who is withdrawing cash, this account holder, if this person happens to be a cooperative society, then wherever you have 1 crore limit, instead you will write 3 crore, which means if the person who is withdrawing cash is a cooperative society, up to 3 crore, no TDS. More than 3 crore, 2% of the excess. Up to 20 lakhs, no TDS. More than 20 lakhs, up to 3 crores, 2% of the excess. More than 3 crores, 5% of the excess. Understanding? So the person who is withdrawing cash happens to be a cooperative society, then wherever you have the 1 crore number in all those places, instead of 1 crore, you will write 3 crores. Okay, we have 2 sections now, guys, 194 and 194K. Very similar sections, therefore we will discuss them together here itself. So in section 194, here we're talking about TDS on dividend. So there's a domestic company which is paying dividend to the shareholder. So for the shareholder, it's an income, guys. And for the shareholder, the source of the income is a company. So at source, tax will be deducted. So therefore, the domestic company will become the deductor of tax and the shareholder will become the deductee of tax. Okay. Now 194, this is coming in your land app section. So here we will deduct tax at the time of payment. So when the company is paying the dividend, at that time they will deduct tax. And the dividend can be any type of dividend. It can be 222A, B, C, D, E, F. It can be any type of dividend. 194 will apply. But what's the limit over here? The limit will depend upon in what mode the payment of dividend is being made. If the company is making payment of dividend to an individual shareholder in non-cash mode, then 10,000 limit will apply, which means if the dividend is up to 10,000, there will be no TDS. If dividend is more than 10,000, then 10% TDS will apply, normal usual limit. But however, if the dividend is paid in cash, see, if it is paid in non-cash mode, then 10,000 limit will apply. But if it is paid in other mode, which means it's paid in cash, for example, then there will be no limit, guys. Even 100 rupees dividend, there will be TDS at the rate of 10%. This is 194. Then comes 194K. 194K will apply, guys, if a mutual fund is paying income to the unit holder. You know, right? The mutual fund, let's say I go and buy units of the mutual fund. Now the mutual fund will give me income, guys. So whatever income I get from the mutual fund, for me the source of the income is mutual fund. So at source I will deduct tax. So the mutual fund will become the deductor of tax and I will become the deductee of tax. Here they will deduct tax at the time of payment or credit, whichever is earlier. Here no question about mode of payment and all. Straight away I'll apply the limit. Up to 10,000 there will be no TDS. Only if it is more than 10,000 there will be TDS at the rate of 10%. So, in 194 and in 194K, if you see, in 194 we deduct tax at the time of payment. But in 194K we deduct tax at the time of payment or credit, whichever is earlier. In both the sections, guys, limit is the same, 10,000, 10,000. TDS rate is the same, 10%, 10%. But in 194, we have an extra point, and that is, if the dividend is paid in cash mode, then no limit, straight away 10% TDS. That point you don't have in 194K. In 194K, there is no concept of mode of payment. We straight away have the limit that up to 10,000 no TDS, more than 10,000 there will be 10% TDS. Okay guys, yes, and 194 is not applicable to dividends paid to LIC, GIC is General Insurance Company, or any other insurer. So any dividend paid to insurance company, 194 will not apply. Now come on guys, let's go to the next section altogether, section 192, which talks about TDS on salary. Now this is a very different section altogether. So here, let's say there's an employer and there's an employee. So employer is paying salary to the employee. So for the employee, the salary is income, and for the employee, the source of this income is the employer. So at source, the employer will deduct tax. So employer will become the deductor of tax and the employee will become deductee of tax. Okay. Now when is tax going to be deducted in section 192? Here we will deduct tax at the time of payment. Come on everybody, again, what are the sections where we deduct tax at the time of payment? What was your hint? Land dab 24, 194 LA, 194 N, 194 DA. Then in B we have two sections, B and BB. Then in 2 we have two sections, 192 and 192A, and then we have 194. So we already know 194 LA, 194 N also we know cash withdrawals, 194 DA we know your life insurance maturity proceeds. In 194B we know both 194B and BB. B is for casual winnings and BB is for horse race winnings. 192 we already knew 192A RPF withdrawal. Now we are learning salary, and then 194 dividend. So once we're done with section 192 guys, all the land dab sections we would have completed. Okay, so section 192 we will deduct tax at the time of payment. Now see a very interesting point in 192. How will TDS be computed in section 192? In 192, TDS on salary, employer will compute what is employee's income. Employer will compute what is the tax on that income on the basis of slab rate, and that is what the employer will deduct as tax. So therefore, if the employee's income happens to be within basic exemption limit, then tax will be 0 guys. So TDS also will be 0. But if the employee's income which the employer is computing happens to be more than the basic exemption limit, then there will be tax liability guys on the basis of slab rate, and whatever is a tax on the basis of slab rate, that is what will be deducted as TDS by the employer. You're getting my point. So therefore, are you noticing how much TDS will be deducted under section 192 does not depend upon just the salary of the employee? No, it depends on the total income of the employee. If the total income of the employee is within basic exemption limit, then tax will be 0. If tax is 0, TDS will also be 0. But if total income of the employee is more than the basic exemption limit, then there will be tax on the basis of slab rate. So whatever is a tax on the basis of slab rate, consider rebate, surcharge, marginal relief, cess, consider everything. On the basis of slab rate, whatever tax you get, that is what the employer will deduct as TDS. Okay guys, now listen, how will the employer know what is the employee's IFHP income? See, employer will know how much is the employee's salary income. But to compute total income, the employer needs other information, right? Like employer needs to know, do you have any IFOS income? Do you have any Chapter 6A? Do you have any losses? Employer needs all that information. Only on that basis, employer will be able to compute a total income. So that is why the law is giving one option to the employee that if you want, you can let the employer know what are your other incomes, what is your Chapter 6A, then do you have any loss from house property, your TDS or TCS credit, you can let the employer know all this. But see, is it mandatory for the employer to tell the employer about his other incomes? It is not mandatory. It's up to the employee. So whatever the employee tells the employer, on the basis of that limited information, employer will compute the total income. But listen to me. If the employee is suffering from losses, only loss from house property only, he can inform the employer. Other losses, he should not inform the employer. Even if he informs the employer about other losses, the employer will not consider. So only one loss will be considered by the employer, and that is loss from house property. Other losses, employer will not consider. Reason is simple guys. Other losses and all, you must have learned this in set off and carry forward chapter. Other losses and all, the employee can adjust, you can set off only if you have filed ITR on time. It is only loss from house property, which even if you don't file your ITR on time, you can still adjust. So that is why loss from house property, you can inform the employer. But other losses, we don't know when you're going to file your return, whether you're going to file on time or late, we don't know. So therefore, if let's say employee informed employer about his other losses, let's say employer adjusted those other losses, but let's say later employee did not even file ITR on time, then that adjustment of losses will become wrong, no. So to eliminate that confusion and that hardship, we are telling the employee, listen, if at all you're telling the employer about your other information, tell about other losses, tell only about loss from house property. Don't tell about other losses. Now one question will arise. You will definitely have one question now that, ma'am, to compute income, two regimes are there. Normal regime and default regime, two regimes are there. So we are saying that employer is going to compute employee's total income. Now on the basis of which regime is the employer going to compute? That question will arise, no. So for that, listen to me guys, the employer will compute the total income of employee in the regime whatever employee tells the employer. Which means if employee tells the employer that he wants to opt out, if employee tells the employer I want to do as per normal regime, then employer also will compute as per the normal regime. If employee doesn't say anything, then by default it is a default regime. But if the employee wants to do the computation as per the normal regime, he should tell the employer. So whatever regime he tells the employer, on that basis only employer will compute the total income. Okay guys, then we have very important 2 points. I'll help you understand. See, long back in salaries chapter, when I taught you HRA, I had told you in HRA you will get one exemption guys. 3 things you calculate, out of the 3 things whichever is the least will be exempt. That time I had told you that this exemption you will enjoy only and only if you have rental expense. Only then you will enjoy this exemption. So if assessee is claiming HRA exemption, he has to prove to the employer that he has rent expense. How will he prove to the employer? That is what I am teaching you now. If the rent happens to be at least 3,000 per month, then he should furnish rental receipt. If the rent happens to be more than 1 lakh per annum, then employee should inform what is a landlord's PAN number. Okay, so this is extra information, extra formality. This you should remember. This you can ask in MCQs, guys. Be careful, it's an untested area. They've not tested this till now. So if the rent happens to be at least 3,000 per month, then the employee has to furnish rental receipt. If the rent happens to be more than 1 lakh per annum, then the employee has to furnish the landlord's PAN. Got it, guys? Yes, so this was our entire discussion of section 192. So we are starting off with section 194P first. Now in 194P, very unique section. So we have only 2 sections, okay, where TDS is on the basis of the slab rate. Those 2 sections are section 192 TDS on salary and section 194P, what we're going to be learning now. Now in section 194P, it's a very simple section, very straightforward section. There are 2 people in our story. On one side, we have the deductor, which is a specified bank, that is some scheduled bank. Okay, and on the other side, the deductee, that is a person who is earning the income, the deductee is a specified senior citizen. The point to be noted over here, I'm not saying senior citizen, I'm saying specified senior citizen. This word specified means a senior citizen who fulfills 6 conditions, guys. Condition number 1, you have to be an individual. Condition number 2, you have to be a resident. Now listen guys, if it's a senior citizen, generally we say you have to be at least 60 years. But specified senior citizen is what I'm talking about over here. He has to be at least 75 years, not at least 60 years, at least 75 years. Okay, so condition number 1, you must be an individual. Condition number 2, you must be a resident. Condition number 3, you must be at least 75 years. Condition number 4, you must be having pension income. This is mandatory. You must be earning pension income. And whatever pension income you're earning, that pension income should be credited into your bank account, and your bank account should be where? Inside the specified bank. You're understanding? So there's a connection between this senior citizen and this bank. What is a connection? The senior citizen is earning pension income, and that pension income is being credited into the bank account of the senior citizen. Which bank account? A bank account which he has inside the specified bank. Okay guys, then condition number 5, this specified senior citizen is not having any other income, no other income. But however, if at all the assessee does have some other income, he can have interest income from the same bank. Having pension income, this is mandatory. It is must. Assessee must be having pension income. But assessee should not be having other income. If at all he wants to have other income, max to max he can have bank interest income like FD interest income or savings account interest income or RD interest income. But that interest income also has to be from the same bank only. If you want real clarity, you straight away come to my exercise over here. See, assessee is having pension income which assessee is receiving in HDFC Bank. And he's also having bank interest income like FD interest income or savings interest income from the same HDFC Bank. Is my condition fulfilled? Yes guys, condition is fulfilled. Why condition is fulfilled? Let's say assessee is an individual. Let's say he's a resident. Let's say he's at least 75 years old. Having pension income is mandatory and he's having pension income. Any other income he should not have. Only one exception, he can have interest income. And that too, the interest income has to be same bank. Yes guys, it is interest income in the same bank, therefore condition fulfilled. But however, if assessee is earning pension income which he is receiving in his HDFC bank account and he's having bank interest income which he is receiving from SBI bank account, here condition will not be fulfilled. Why? Having pension income is mandatory. Assessee is having pension income. You should not have any other income. Max to max, you can have interest income. But that interest income has to be from the same bank. Here, interest income is in a different bank. Gone. Condition is not fulfilled. Okay, then look at my third situation. I am having pension income, guys, which is getting credited into my HDFC bank account, and I'm not having any bank interest income. Is the condition fulfilled? See, what is mandatory? Having pension income is mandatory, and I'm having pension income. Having bank interest income is only optional. It is not mandatory. The law says you should not have any other income. If at all you have any other income, max to max, it can be interest income only. The law is not saying you should be having interest income. Law is not saying. So having pension income is mandatory, and I'm having that income. Having bank interest income is not mandatory. I don't have the bank interest income. It's fine. Conditions are fulfilled. Got it? This is where you would have gotten the real clarity. Okay guys, then I don't even have pension income, but I'm having bank interest income. Will the conditions be fulfilled? Of course not, because having pension income is mandatory. Now you understood, guys. So having pension income is mandatory. Other income assessee must not have. If at all indicates interest income is only optional. So if at all my assessee has any other income, max to max it can be interest income only, but that too it has to be interest income from the same bank. And lastly, this person should have given a declaration saying that all these conditions are fulfilled. So if a person fulfills these 6 conditions, then he becomes a specified senior citizen. So the person who's a deductor of tax over here is a specified bank, that is a scheduled bank. The deductee, the person who's earning the income over here, is specified senior citizen. If this situation exists, then the banker, that specified bank, guys, the bank will compute the income of the deductee. That income will have how many components, you tell me? This deductee is specified senior citizen. Max to max 2 incomes this person will have. Number 1, he will be having pension income. This is definitely he will be having. And then apart from this max to max, he will be having interest income only. Now don't you think, guys, this bank will know both these incomes? Because pension is getting credited into HDFC bank account only, and interest income also this assessee is earning from HDFC only, and this assessee is not having any other income. So the bank will know total how much income this person is having, guys. So on that basis, the bank will compute the GTI. The bank will see what's a chapter 6A. The bank will compute the total income of the specified senior citizen. On this total income, the bank will sit and compute the tax liability on the basis of the slab rates, 87A, surcharge, marginal relief. The normal tax liability computation bank will do for the specified senior citizen. Okay, then see, pension income is from the salaries, relating to the salaries head, guys. So against pension income, the employer who's giving the pension income would have subtracted 192 TDS. So because to that extent the government has already received tax, we will subtract that 192 TDS credit, guys. Then on this interest, the banker itself would have already subtracted 194 TDS. So whatever TDS has already been deducted against the assessee's income, of course we will deduct it, because to this extent the government has already received tax from the assessee. So whatever is a balance tax, that will become 194 TDS. Now 194P, how will you remember? P for pension. Okay, so in 194P, one last revision, guys, the banker will do all the hard work. The banker will find the total income of the specified senior citizen, his tax liability. The banker will subtract the TDS credits and all. Whatever is a net number, the banker will deduct as 194P TDS and remit it to the government. Remember this point, guys, it's extremely important. If the banker has deducted tax under 194P, then the deductee need not file ITR. Got it? Extremely important point this was. Alright, so this was your entire discussion on 194P. Now come on, let's go to our next section, section 194Q. So in 194Q, guys, there are 3 simple conditions. Your condition number 1, the buyer should be a person whose preceding previous turnover is 10 crores. Guys, is this same as R hijack? No, it is not same as R hijack. I'll tell you why. There are 2 differences. Number 1, I'm not saying only individual or HUF. I am covering all buyers. So it doesn't even matter whether you're an individual, whether you're a HUF, whether you're a company, doesn't matter. We are covering all buyers over here, not just individual and HUF. Then in our hijack sections, we say preceding previous turnover has to be more than 1 crore. Here we are saying 10 crores. So it's different. So this is not our hijack section, okay? So in 194Q, basically what happens, I'll tell you. So I have the buyer on this side and I have the seller on this side, guys. The seller has sold goods to the buyer. Now the buyer is going to pay the consideration to the seller, right? Now this consideration is what my subject matter of my entire section is. For the seller, this consideration is going to be income. income. So the seller and the source of this income is going to be buyer. So at source, buyer will deduct tax, buyer will become the deductor of tax, and the seller will become the deductee of tax. You're understanding? So this buyer, this deductor, his preceding previous year turnover has to be at least 10 crores. No other TDS section should apply, no other TCS section should apply, and the aggregate transaction between this buyer and seller has to be more than rupees 50 lakhs. So if all these three conditions are fulfilled, only then 194Q will apply. If all these conditions are fulfilled, guys, the TDS rate will be 0.1%. Very small amount of TDS, 0.1%, but 0.1% of the excess. Why, guys, excess? Tell me, what are the other sections in your syllabus which we have learned till now where we deduct tax on the excess, guys? Only two sections. We first saw this word excess in section 194N, remember, your cash withdrawal section, and now we are seeing in section 194Q. In all the other sections, if the amount is more than the limit, then on the entire amount we deduct tax, but in only these two sections till now we deduct tax only on the excess. So TDS rate is 0.1% of the excess. And when will we deduct tax? As usual, guys, payment or credit, whichever is earlier. Now see, let's say for example the rent is 80,000 rupees, okay, and for example let's say GST 10% is applicable, 8,000 rupees. If total amount I am paying rent 88,000 rupees, then TDS will be deducted only on 80,000 rupees on the amount before GST. Do you remember this, guys? On the GST component we don't deduct tax. Tax is always deducted. TDS is always computed on the amount before GST. But 194Q, super special section. Like for example, let's say I'm making payment for goods 1 lakh rupees, okay, and let's say GST 5% is applicable, for example, so 5,000 rupees. So total 1 lakh 5,000 I'm paying. If payment is earlier, then including GST, tax will be deducted on 1 lakh 5,000. Okay, if credit is earlier, then on the amount before GST, on 1 lakh, on the amount excluding GST, tax will be deducted. And then we have just two more points. In the first year of business, if it is a first year of business, 194Q will not apply. Simple reason, in the first year will you have preceding previous year turnover? No, right? So therefore in the first year 194Q will not apply. And if you're doing any transaction in the stock exchange, like for example if I'm buying and selling shares in the stock exchange, 194Q will not apply. So three conditions: buyer's preceding previous year turnover has to be at least 10 crore rupees, no other TDS, no other TCS should apply, aggregate transaction between the buyer and the seller has to be more than 50 lakh rupees. If all these conditions are fulfilled, then at 0.1% of the excess above 50 lakhs, tax will be deducted at source at payment or credit, whichever is earlier. If payment is earlier, you will also include GST. If credit is earlier, you will not include GST. Alright, this is it with section 194Q. Make one small correction, please. The buyer's preceding previous year turnover has to be more than rupees 10 crore. I had written more than or equal to, that is wrong. It has to be more than rupees 10 crore. Okay, make that small correction. Alright, so that's it, guys. This is it with 194Q. So until now, we have learned most of the TDS sections. Only two TDS sections are left, 194R and 194T. Let's take them up one by one. First, talking about section 194R now. This is about TDS on perquisites. Perquisites not salaries chapter, guys. PGPP chapter. Let's take one example. Let's say I have ITC over here and I have a stationery shopkeeper on the other side. Okay. So ITC is telling the shopkeeper that, listen, if you sell 1,000 classmate notebooks in 1 month, I will give you a gold coin. The shopkeeper sold 1,000 notebooks, guys, in that particular month. So ITC gave a gold coin to the shopkeeper. So do you agree that the shopkeeper has received a benefit or a perquisite? He got a gold coin, guys. It can be in cash or it can be in kind. In my example, it is a gold coin, so it is in kind. And it is related to business or profession of the shopkeeper. Shopkeeper is not just like that getting one gift from ITC. No. Shopkeeper is getting the gold coin because in his business, he sold more than 1,000 classmate notebooks. So the benefit that he is getting is relating to the shopkeeper meeting his sales target. It is relating to his business or profession. You're understanding? So ITC has given a benefit or a perquisite to the shopkeeper, gold coin. It can be in cash or it can be in kind. It has to be related to the business of the recipient. Okay, if these conditions are fulfilled, first of all, do you agree for the shopkeeper this gold coin is going to be an income, guys? It's a benefit or a perquisite for him relating to his PGBP head. It's a taxable income for him, a taxable income under 28 clause 4. So, and the source of the income for the shopkeeper is ITC. So ITC at source will deduct tax. ITC will become the deductor of tax and the shopkeeper will become deductee of tax. Okay, but however, 194R guys, it's an R hijack section. Finally, we have learned the last section in our R hijack series. Because it's an R hijack section, you know what will happen now. I will trouble whom? I will trouble the deductor. If the deductor happens to be an individual or HUF, his preceding previous year turnover has to be more than 1 crore or preceding previous year gross receipt has to be more than 50 lakhs. Any other person, then fine. But if he's individual or HUF, this condition has to be fulfilled. Understanding guys. Then another question will arise that when will tax be deducted under 194R? Whenever ITC is giving the benefit to the deductee, no. Before giving the benefit, they will deduct the tax. So here I don't have payment or credit. I don't have all that. Very different. Before the deductor gives a benefit to the deductee, before ITC gives a gold coin to the shopkeeper, they will deduct tax. Okay guys, but at what rate? The TDS rate over here is going to be 10%. I think I've missed it. I've not mentioned it over here. The TDS rate is going to be 10%, and only if the value of the benefit happens to be more than 20,000 rupees. If the value of the benefit is up to 20,000 rupees, then there will be no TDS. Okay, now see, in my example gold coin, it's in kind. How will you find the value of that gold coin? It depends. If ITC has purchased the gold coin from the market, then you will take the purchase price. But if ITC has manufactured the gold coin, then you will see at what price they would have sold that same gold coin to the customers. In simple words, you will look at the selling price number before GST, after subtract, or I'm not saying MRP, not the MRP number, instead the selling price number, which means subtract all discounts and all. Before GST, take at what price the ITC would have sold the same gold coin to the customers. That is what the value of benefit of kind in that is what the value of the benefit in kind will be. If the benefit happens to be in kind, then ITC, like for example in our gold coin example, ITC will ensure that first tax is paid, only then they will release the gold coin. Okay, so till here whatever we've learned, can we do one quick summary? Yes guys, under 194R we're talking about TDS on benefits or perquisites relating to business or profession. They can be in cash, they can be in kind. So ITC has given a gold coin to the shopkeeper for meeting sales target. So the gold coin is a benefit for the shopkeeper, it's a perquisite for the shopkeeper, it is relating to his business or profession, it is taxable for the shopkeeper under the PGPP head, it's an income for the shopkeeper, the source of the income is ITC, so at source ITC will deduct tax. When? They will deduct tax before releasing the gold coin, before providing the benefit, they will deduct tax. If the value of the gold coin is up to 20,000, then they will not deduct tax. Only if it is more than 20,000, only then they will deduct tax at the rate of 10%. Then we learned this is an R hijack section. Then we learned if the benefit happens to be in kind, how will we find the value of the benefit in kind? Very simple. We will see whether ITC has manufactured the gold coin or whether they themselves have purchased it from the market. If they have purchased it from the market, we will take the purchase price. If they have themselves manufactured it, then we will see what is the selling price after subtracting discounts and all. Before GST, what is selling price, at what price do they sell to the customers? That is the value we will take. And then one more thing we learned, if it happens to be in kind, then ITC will first ensure the tax has been paid on the gold coin, only then they will release a gold coin. So till here all the points are clear guys. Now let's see the special points. R hijack section I already told you. Then, will 194R apply if the benefit happens to be a capital asset? Like for example, let's say the shopkeeper has met the sales target. So what if ITC gives a piece of land to the shopkeeper? In our example, it was gold coin, no? So instead of gold coin, what if it is a piece of land? What if the benefit of the perquisite happens to be a capital asset? Doesn't matter. Still 194R will apply. In 194R, the benefit of the perquisite can be in any form guys. It can be in cash, it can be in kind. If it is in kind, it can also be a capital asset, no problem. Okay, then comes my next point. Is 194R applicable to bank loan waiver? See guys, one simple situation, okay, one simple transaction. The banker gave a loan to this person. This loan was relating to the business or profession. It was a business loan. But the borrower was not able to repay the loan, okay. So the banker waived the loan, which means banker is telling the borrower, it's okay, enjoy, you don't have to repay. The banker is waiving the loan. First of all, do you agree that this person over here, Mr. Pink, he has definitely enjoyed a benefit, guys? He borrowed a loan for his business or profession. He is not able to repay the loan. The banker is waiving the loan. He doesn't even have to repay the loan. Definitely he has enjoyed a benefit. And the benefit is relating to his business or profession because the loan was a business loan. He doesn't have to repay his business obligations. It's a benefit for him. That benefit is taxed for him under 28 clause. For in PGPP, it is taxed. This point we had the same example we had seen in PGBP chapter as well. But however, 194R TDS will not apply. So yes, no doubt 194R does apply to whatever benefits or perquisites you get relating to your business or profession. But if it is business loan waiver by the bank, yes, no doubt it is taxable income for you, it's a benefit for you, it is taxable under 28 clause 4, but 194R will not apply to bank loan waiver. One small exception we have over here. Okay, then comes a very important point with respect to social media influencers. See, nowadays, especially in this Instagram age, you must have seen, right, a lot of these influencers are sent products by brands, guys. You must have seen this especially for phones and all. Whenever a new phone is launched, you have these technology influencers, tech influencers. So the brand will send a free phone to the tech influencer. Now, don't you think for the influencer, it's a benefit? He got a phone for free, and of course it's relating to his business or profession, because being a social media influencer, that is his business, that is his profession. So he got a phone for free. He has to just make 2 reels out of it. He has to make 1 detailed video out of it. He got a free phone. He got a benefit or a perquisite. It is relating to his business or profession. 194R should apply. But wait, there are 2 types of these influencer deals, guys. Sometimes what happens is the brand tells the influencers he will send you the phone. You have to make 2 reels. You have to put up 5 stories. You have to make 1 detailed video, and then you have to return the phone back to us. Okay. You tell me, if the product has to be returned back to the brand, then did the social media influencer enjoy a benefit? No, right? So if the products have to be returned, then the social media influencer, he did not enjoy any benefit. If he did not enjoy any benefit, then section 194R itself will not apply. But however, if the brand is telling the social media influencer, see, we are sending you a phone for free, you have to make 2 reels, you have to make 5 stories, and then you have to make 1 detailed video, and then you can keep the phone, then in that case, the social media influencer has truly enjoyed a benefit. Only when he enjoys a benefit, only then 194R will apply. Okay, so the crux of the story is, if the social media influencer, if he has to return the product, then 194R will not apply, because then he did not enjoy a benefit. But if the social media influencer gets to keep the product, then he has enjoyed the benefit. Only then 194R will apply. Okay guys, then we have just 2-3 small points left. Imagine that there's this person, Mr. Red. He's a share trader, okay? So for him, his business itself is buying and selling shares. The company announced bonus shares, guys. So don't you think bonus shares will be something which the share trader is getting for free? So don't you think bonus shares will become a benefit or a perquisite that he's getting, and this benefit is relating to his business because he's into share trading business? That thinking might come into the picture, right? So that is why the act is very clearly saying, listen, if bonus shares and rights shares are given to share traders, that will not come under 194R. It will unnecessarily complicate the case. So that is why they are excluding bonus shares. So bonus shares, no doubt it's a benefit for you. No doubt if you're a share trader, it's a benefit for you relating to your business, because come on, you're getting shares for free. No doubt it's a benefit for you, but still 194R will not apply. So 194R will not apply to bank loan waivers. 194R will not apply to bonus shares and rights shares. Okay guys, then will 194R apply to sales discount, cash discount and rebate and all? No. Like for example, when you place bulk orders, you get a discount, right? For that is a sales discount, cash discount and all. For all that, 194R will not apply. 194R will apply for gold coin example I gave you. Then travel tickets. This is also very popular, okay? I'm not sure if you have seen this. Maybe some of your parents, if they are into business, okay, retail business. Like for example, I've seen this especially in showrooms, like, you know, when people have these Havells showroom, or they're running an Usha showroom, Usha fans and all. So when they have these kind of showrooms, these electrical items, okay, here when they sell a certain number of units, when they meet sales target, they get free travel tickets, like 2 tickets to Australia or 2 tickets to Vietnam. They get free travel tickets. So why are they getting the free travel tickets? Because they met a sales target. So they're getting a benefit or a perquisite relating to the business or profession. 194R will apply, guys. Then the free medicines example I already told you. The pharma company is giving free medicines to the doctor. So for the doctor, it's a benefit which he's getting relating to his profession. So therefore, that benefit will come under 194R. Okay guys, now come on, let's go to our last section in our TDS discussion, section 194T. This is a brand new section brought in by the Finance Act 2025. This section will apply in the intermediate examination for the first time May 26 examination onwards. A new section, guys, but an extremely simple section. You wait and see. This much only, that's all. So here we have on one side partnership firm or LLP, and on the other side we have the partner. The partner is earning, see, you know, right, the partner gets three things from the firm: share of profit, we don't talk about it because it's anyways exempt, salary and interest. Salary and interest are taxable. So our whole discussion is about that salary and that interest only. Salary, whether you want to call it a salary, remuneration, commission, bonus, these will be one category. And interest. So when the partner is getting from the firm any remuneration or any interest, it is taxable income for the partner. And the source of the income is the firm or LLP. So at source, the firm will deduct tax, guys. So the firm will become the deductor of tax and the partner will become the deductee of tax. Okay. Now they will deduct tax at the time of payment or credit, whichever is earlier. The limit over here is 20,000. Only if this aggregate put together happens to be more than 20,000, only then there will be TDS at the rate of 10%. Alright, if the amount paid or credited in the year is more than 20,000, then TDS at the rate of 10% will apply. That's all. So there's a partner is getting salary or interest from the firm. The firm, if the firm will deduct tax under 194T at the rate of 10% if the amount of the remuneration or the interest whatever is more than 20,000. The concept is this much only, but unnecessarily students are complicating this. So listen to my small concept test over here. Partnership firm gave interest to the partner 1 lakh rupees. For the partnership firm, how much will be allowed in PGBP, guys? Remember 12% limit we have. So under section 40B, let's say only 80,000 is going to be allowed for the partnership firm. They are paying interest 1 lakh, but for the partnership firm in PGBP 40B, only 80,000 is going to be allowed, let us say. Now 194T TDS will be deducted on what? Will it be deducted on 1 lakh on the actual interest, or will it be deducted on 80,000, which is as per 40B? See, the question, the section over here, anywhere does it talk about 40B? No, guys. The section says we will just see what is the amount paid or credited. In my example here, what is the amount of interest, guys? 1 lakh. That's all. Tax will be deducted at on 1 lakh. We will simply see what's the total interest, total salary on that amount. If it is more than 20,000, there will be TDS at the rate of 10%. Alright, guys, that's it. So with this, we are done with the sections of TDS. All the sections we have completed. Then we have some special transactions, guys. Now, what are these special transactions? So basically, I have 3 special transactions for you, okay? These are those special transactions which are not mentioned in the Act, but we have notifications and circulars which talk about these transactions. Important, listen to me. So Netflix has given specifications to Balaji Telefilms that they want a particular movie to be made and how the movie should be, where the shooting should happen, who should be the actors, who should be the actresses, what is the script, what costumes they should wear. So Netflix is giving full specifications to the producer. What is the producer's work? Just produce the movie according to the specifications and then give the movie to Netflix. Even the copyright is given to Netflix only, which means the producer is just doing job work over here. On the basis of the specifications given, they are making the movie and they are giving the movie to Netflix. After this whole thing, the movie is owned by Netflix because even copyright is given to Netflix, guys. So this becomes a typical works contract covered by 194C. It will not come under that important point. Remember, in works contract definition, we had A, B, C, C, important point. Important point was I or my associates are giving material or specifications, then that will become a works contract. But this situation over here will not come under the important point because only specifications are given. Material is not given over here. This point will come under point B. B is broadcasting, telecasting, producing programs for broadcasting and telecasting. Don't you think the producer over here has produced a program simply for Netflix to broadcast and telecast on their channel? So therefore, this is a works contract, but not under important point, but instead under point B. What if copyright is not transferred to Netflix? What if copyright is kept by the producer only? Then it will not be works contract. Then no TDS. Then no 194C. This transaction will result into 194C only if condition number 1, Netflix has given specifications to the producer. Okay. Condition number 2, the producer is producing the program on the basis of the specifications and then copyright is also given to Netflix. Only if both these conditions are fulfilled, only then it will become works contract. 194C will apply under point B, producing programs for broadcasting and telecasting. Okay guys, then listen to my second transaction. Now this is going to be a new transaction for you, so listen little extra carefully. See, there are totally 3 parties in our story. We have Tata Motors, we have ad agency, and we have TV channel. Step by step we will go without any tension. First, let me remind you one small point. You remember section 194C, we learned the definition of works contract, and definition was A, B, C, C. Important point. A was for advertisement. Just remember this for now, that advertisement is works contract, comes under 194C. Now what happens is, let's say Tata Motors wants to make one advertisement. They want to make one video advertisement, let's say. They'll come to the ad agency and they will give ad agency money and they will tell them, make an advertisement for us. They will make an advertisement for Tata Motors. Pure advertisement contract guys, works contract 194C. No doubt about this, no tension about this. Discussion itself is not about this. Okay. So here there's an advertisement contract, 194C will apply, no doubt. Now keep this transaction in the side and now listen to me. TV channel. You've noticed, right? Let's say you're watching something on TV. Like for example, let's say you're watching a movie on TV. You must have seen after every 15 minutes, there will be an ad of 5 minutes. There'll be a break of 5 minutes. In that 5 minutes, many advertisements they will show guys. Understand, for the TV channel, this is the biggest source of revenue. You will get irritated by all these ads. But for the TV channel, this is the biggest source of revenue showing these ads. They charge a lot of money guys. For each ad to be telecasted on the channel, they charge a lot of money. So now the TV channel wants revenue. How revenue will come? Only if advertisements are shown on their channel, they will get revenue. So what TV channel will do is, the TV channel will ask for advertisements. What is the ad agency going to do now? They are going to canvas. Canvas means they're going to promote this TV channel. They will tell all their clients, hey listen, whatever video advertisement we've made for you, let's telecast on this particular channel. Okay. Now what will happen is, let's say Tata Motors agrees. So let's say for this for showing this ad on the television channel, let's say the cost is 100 lakhs. So the ad agency will collect 100 lakhs from Tata Motors and will give 100 lakhs to the television channel. And don't you think now television channel made so much money, all because of whom? Because of the ad agency. Because the ad agency canvassed for the TV channel. Ad agency went and told Tata Motors, listen, let's show your ad on the TV channel. That is why Tata Motors agreed, paid 100 lakhs and TV channel got this 100 lakhs. So to thank ad agency for their services, TV channel will give some commission to the ad agency. Let's say 15% commission, for example. 15 lakhs commission they will give to ad agency. Our whole focus is on this 15 lakhs commission now. Commission guys. So you will think about 194H. Obviously, it is not lottery commission. It is not insurance commission. Other commission, you will think about 194H. But 194H will not apply. It is clearly mentioned 194H will not apply on this commission. Okay, so then what happened is, the income tax officers, they started applying 194C over here because it is connected to advertisement. So relating to this only, we have a circular of the income tax department. CBDT gave a circular which clearly said that on this commission, neither 194H will apply nor 194C will apply. No TDS will apply on this commission. Which commission? Commission which TV channel is giving to the ad agency, on that commission, no section TDS will apply. You understood guys? Now see, whether Tata Motors gives 100 lakhs to ad agency gives 100 lakhs to TV channel gives 15 lakhs to ad agency, whether I do it like this, or there can also be a case where ad agency directly gives 85 lakhs to the TV channel. Answer will be the same only. Ad agency has, from that 100 lakhs, they have deducted 15 lakhs commission and they are giving 85 lakhs to the TV channel. So it will still be the same only. It will be as if ad agency has given 100 lakh to the channel and got 15 lakh commission. 15 lakhs will still be the commission in this case. So whatever be the commission, whether the ad agency deducts the commission and pays to the TV channel, or whether they pay the whole 100 lakh and then again TV channel pays commission to them, whatever it may be, on that commission relating to the ads between TV channel and ad agency, on that commission, no section TDS will apply. Neither 194H will apply nor 194C will apply. Is everybody having the required clarity now? Perfect clarity guys. Then coming to the third special transaction, this is with respect to natural gas. See guys, natural gas has to be transported. Let's say person A has sold natural gas to person B. Now after the sale, the natural gas has to be transported from A's factory to B's factory. Now transportation guys, transportation is nothing but carriage of goods or passengers by any mode other than railways. Welcome to section 194C. Come on guys. A, B, C, important point. One of the C is for carriage. and carriage means transportation. So on that transportation charges, of course, which section will apply now? 194C will apply, but there's a condition. On the transportation charges with respect to natural gas, 194C TDS will apply only if first ownership is transferred and then transportation happens. If first transportation happens and then ownership is transferred, then on that transportation charges 194C will not apply. So whatever transportation charges are incurred relating to natural gas, yes, no doubt transportation charges is carriage. Carriage comes under 194C. No doubt 194C will apply, but there's a condition for this 194C to apply in this case. Condition is first ownership has to be transferred, only then transportation should happen. Only if this condition is fulfilled, only then the transportation charges will come under 194C. Okay guys, so but what will happen if first transportation happens and then ownership is transferred? Then 194C will not apply. Okay, so these were my 3 special transactions with special concepts with respect to TDS. Now come on guys, come to my next discussion, section 206AA. This is a very important concept. This section will impact all the TDS sections. See, who is the main person in TDS? Let's start from the basics. Understand this section properly, because similar section you will have in TCS also. So who is the main person in TDS? Who is deducting tax, guys? The deductor is a main person in TDS. Now deductors, TAN is mandatory. Now who is the other person? The other person will be the deductee. The deductee is PAN or Aadhaar. Any one he has to give, it is mandatory. So understand this basic point first. With logic, I will try to explain to you. The main person is a deductor. The person who's deducting tax, his TAN is mandatory, and the other person is a deductee, his PAN or Aadhaar, at least one he has to give, it is mandatory. But however, if the deductee neither gives PAN nor gives Aadhaar, even PAN is not giving, even Aadhaar is not giving, welcome to 206AA. Understanding guys, main person, come on, sing the song. Main person in TDS is a deductor. Deductor's TAN is mandatory. Other person is deductee. Deductee's PAN or Aadhaar, give at least one. If the deductee is not giving PAN, also not giving Aadhaar, that is when I will think about 206AA. Now what 206AA says is that if the situation arises, if the deductee neither gives PAN nor gives Aadhaar, we will change the TDS rate. Doesn't matter which section guys. Remember, 206AA will apply for all sections. If 206AA applies, then the TDS rate itself will change. Whatever is the rate of that particular section, or 20%, whichever is higher. Like for example, in 194A, the TDS rate is 10%, 10% or 20%, which is higher, 20%. In 194B, your casual winnings, the TDS rate is 30%. So the rate 30% or 20%, whichever is higher, 30%. So whatever is the applicable rate of that particular section, or 20%, whichever is higher. But if it is 194Q, remember 194Q we learned some time back guys, relating to goods. So if it is 194Q, then whatever is the rate, or 5%, whichever is higher. So the TDS rate itself will change. Okay guys, so this is about 206AA. This shows you the importance of the deductees, PAN or Aadhaar. Alright, now listen, we are going to do a nice analysis. We are going to compare 2 sections with 206AA, 194C and 194IB. Now see, in section 194C, if you remember, we had learned one special point. I'll remind you. I'll take you to 194C again. Here, look at this. We had learnt one particular situation where 194C is not applicable. If the deductee is in the business of plying, hiring, leasing goods carriages, which means he's a truck operator and he owns not more than 10 goods carriages at any point of time in the previous year, and PAN, Aadhaar at least one if he is furnishing, then, and if he's also giving a declaration that all these conditions are fulfilled, then 194C itself is not applicable. Remember guys, when I have to pay transportation charges to the truck operator, when I have to pay transportation charges for transporting my goods from one place to another to a truck operator, then I think about the situation. Deductee is a truck operator, person in the business of plying, hiring, leasing goods carriages, does not own more than 10 trucks. PAN, Aadhaar, at least one he's furnishing, and he's also giving a declaration that all these conditions are fulfilled, and 194C will not apply. Now listen, in this situation, what if PAN, Aadhaar, he doesn't furnish? PAN, Aadhaar, even one is not furnishing guys. He's neither furnishing PAN nor he's furnishing Aadhaar. Not even one is furnishing. Then in that case, this condition will not get fulfilled. Yes, are you with me? This condition will not be fulfilled. If this condition is not fulfilled, then this exception will not apply, which means 194C will apply. 194C will not apply only if all these conditions are fulfilled. If one condition is not fulfilled, then 194C will apply. Now, along with 194C, because the deductee is not giving PAN Aadhaar, not only will 194C apply, don't you think 206AA will also apply? Are you understanding slowly in what direction I'm taking you? Yes, guys, see, I'll bring you back to the situation over here. Look at this. Deductee is a truck operator. Condition 1 fulfilled. He doesn't have more than 10 goods carriages. Condition 2 fulfilled. PAN, Aadhaar, at least one he is giving. Condition 3 fulfilled. He also gives a declaration that all these conditions are fulfilled. So all my 4 conditions are fulfilled. Now that exception will apply. 194C TDS will not apply. Even 194M will not apply. No TDS at all, guys. No TDS at all. Why 194M will not apply? See, whenever 194C doesn't apply, we come to 194M. But in 194M, we have our checkpoints. One of the checkpoints is why is 194C not applicable? Either because it's a personal transaction or because preceding previous turnover gross receipt condition is not fulfilled. Here 194C is not applicable not because of the personal point. Also not because of the preceding previous turnover gross receipt point. Here 194C is not applicable because the situation is fulfilled. So therefore 194M, your third checkpoint will not get fulfilled. So neither 194C will apply nor 194M will apply. No section will apply, guys. Simple. However, come to the second situation now. Deductee is a truck operator. He's in the business of plying, hiring, leasing goods carriages. My first condition is fulfilled. He doesn't have more than 10 goods carriages. Second condition is fulfilled. PAN, Aadhaar, at least one he should give, guys. Even one he's not giving. He's neither giving PAN nor he's giving Aadhaar. He's not giving a declaration that these conditions are fulfilled. So therefore, now that situation is not, now one condition is not fulfilled. Because one condition is not fulfilled, the exception will not apply. 194C will apply. But because the deductee is neither giving PAN nor giving Aadhaar, 206AA will also apply. So therefore, what will the TDS rate become now? In 194C, the TDS rate depends upon who the deductee is. If the deductee is individual or HUF, then 1%, otherwise 2%. 206AA says whatever is the applicable rate or 20% whichever is higher. Obviously 20% will be higher. Got it? Now I think you would have understood. So if in the special situation in 194C, if the truck operator is neither giving PAN nor giving Aadhaar, then not only will 194C apply, 206AA will also apply, because of which TDS rate will become 20%. On the other hand, PAN, Aadhaar, at least one if he gives, 194C itself will not apply, no TDS will apply. So 0 TDS here, 20% TDS here, because of one mistake. Then come to my third situation. Again, deductee is a truck operator, which means my condition 1 is fulfilled. But guys, he is having more than 10 goods carriages. So which means my second condition is not fulfilled. So my special situation will not apply, 194C will apply. But deductee is giving PAN, Aadhaar, at least one is giving, so 206AA will not apply. 194C only will apply. 194C TDS rate will be 1% or 2% depending upon who the deductee is. So if the truck operator has more than 10 goods carriages, special situation will not apply, 194C will apply, the usual rates. Okay guys, this was 206AA plus 194C. Now comes 206AA plus 194IB. Now in 194IB guys, there was one concept which I had kept pending. I'll show you the section. In 194IB over here, see this point I had kept pending for you, that TDS cannot exceed last month's rent. This is the point which we are going to take up now in this situation. See 194IB, let's say 194IB is applicable. 194IB, I have 4 checkpoints. Let's say all the 4 checkpoints are fulfilled. 194IB is applicable. When do you think about 194IB? First of all, if it is rent, but 194I is not applicable, then you think about 194IB. Let's say 194IB is applicable and deductee is neither giving PAN nor giving Aadhaar, which means 194IB is applicable, 206AA is also applicable. So what will be the TDS rate now? TDS rate will be whatever is the applicable rate in that section, which is 2%, or 20%, whichever is higher, obviously 20% guys. And let's say the monthly rent is 60,000 rupees. Okay. So now we know that in 194IB, every month we don't deduct tax. We deduct tax only in the last month. So last month is March month guys. Remember, we deduct tax when? In the last month. We deduct tax for which period? For the entire period. So in the March month, I will deduct tax for the entire year. So 60,000 is a rent per month for the entire year. So into 12 months, into 20% TDS. How much will this be? Calculate and tell me. 60,000 rent per month into 12 months into 20%, you will get 1,44,000 guys. So can I subtract 1,44,000 TDS over here? Does it make sense to you? Tax has to be deducted from last month's rent. Last month's rent is 60,000. How can I deduct 1,44,000 from that? Does it mean this particular month landlord will give me money instead? No. So that is why we have a provision in 194 IB that the TDS should not exceed last month's rent. So even though it is 1,44,000, we will deduct how much? We will deduct only 60,000. Balance you can ignore. We will deduct only 60,000. So in March month net we will give 0 only to the landlord. Under 194 IB, TDS cannot exceed last month's rent. Now you understood. So because of 206AA, there's a possibility that the TDS may be more than the last month's rent. In that case, you have to restrict it. You can't have a negative number because of TDS, guys. So you will restrict the TDS to the last month's rent. Balance you will ignore. Okay, so this was about your 194 IB. So with this entire 206AA, you've understood. 206AA, whose PAN or Aadhaar is required? Deductee. Deductor's TAN is required. Deductee's PAN Aadhaar is required. If it doesn't give PAN, also doesn't give Aadhaar, then consequence. What's the consequence? Whatever is the applicable rate or 20%, whichever is higher. But 194Q, whatever is the applicable rate or 5%, whichever is higher. Okay guys, then coming to one last concept in our TDS discussion, and after this we start making our charts. This point I've already told you. If rent is 1 lakh and GST is 18,000 and if total is 1 lakh 18,000, will TDS be deducted on 1 lakh or on 1 lakh 18? This we already learned that we always deduct tax on the amount before GST, so on 1 lakh. In 194Q only we had a special point that if payment is earlier, then you will include GST. If credit is earlier, you will exclude GST. But other sections, you always deduct tax on the amount before GST. Basically, on the GST component, we don't deduct tax. Okay guys, so with this, the learning part of TDS is over. Look at the first chart over here. In this chart, I'm trying to compare 4 sections. 192A, RPF withdrawal. 194LA, compulsory acquisition. 194DA, life insurance maturity proceeds. And 194IA, immovable property. First, let's talk about each section one by one. In 192A, what's the limit? The limit is 50,000. If the RPF withdrawal is at least 50,000, so abnormal limit we have. If it is at least 50,000, TDS will be applicable at what rate, guys? At the rate of 10%. And when do we deduct tax in 192A? At the time of payment, not payment or credit, at the time of payment in 192A. Then in 194LA, here what's the limit? Here, if the amount is more than 5 lakhs, we will have TDS. At what rate? At the rate of 10% again. And when do we deduct tax here? Here also we deduct tax at the time of payment. Land DAP 24, remember? We deduct tax at the time of payment over here. Then tell me about 194IA. Here what's your limit? Here you have an abnormal limit, guys. If the amount is at least 50 lakhs, then there will be TDS. TDS will be at the rate of 1%. But when do you deduct tax? This is not land DAP section. So we deduct tax at the time of payment or credit, whichever is earlier. Okay. Now 194DA, your life insurance maturity proceeds. Here the limit is at least 1 lakh. Again, abnormal limit we have. If the amount is at least 1 lakh, there will be TDS. TDS will be at the rate of 2% of the net amount. Remember guys. And land DAP 24, this is a land DAP 24 section. So here we deduct tax at the time of payment. Now what I want to show you is 192A, 194LA and 194DA. What is a common point between these 3 sections? 192A, 194LA and 194DA. All the 3 sections are your land DAP sections. So in all these 3 sections, we deduct tax at the time of payment. They are land DAP 24 sections. 192A, 194DA and 194IA. Between these 3 sections, what's a common point? If you noticed, there are only 3 sections in our entire syllabus where we have abnormal limit, and that is these 3 sections. In 192A, it is at least 50,000. 194DA, it is at least 1 lakh. 194IA, it is at least 50 lakhs. So in all these 3 sections, we have abnormal limits. Are you understanding? Okay, so just one small chart we made over here to show some common points. We have abnormal limit only in these 3 sections, guys, 192A, 194DA and 194IA. Okay, then this you already know that we have some sections where we deduct tax at the time of payment, your land DAP 24 sections. This you know. All other sections, payment or credit, whichever is earlier. Then in which sections we think about personal transaction, HIJC, even this you know. Then tell me which sections we have abnormal limit. Just now we saw only 3 sections we have abnormal limit, guys. We have abnormal limit in 194IA, we have abnormal limit in 192A and in 194DA. In 194IA, your abnormal limit is at least 50 lakhs, 192A at least 50,000, 194DA at least 1 lakh. Okay, then tell me, there are two sections we learnt in our entire syllabus where we deduct tax on the basis of slab rate. Slab rate, only two sections you have. One is section 192, your TDS on salary, and the other is section 194P, which was your TDS on that pension specified senior citizen, that section. Then tell me which sections we saw excess, that we will deduct tax on excess. Two sections we had, guys. 194N, your cash withdrawal, and 194Q, purchase of goods, that section. Okay, then listen to this point. Okay, this is something which I have not discussed with you ever before in this chapter. See, in all the sections, the deductee has to be a resident. The deductor, I don't care. Deductee has to be a resident in all the sections. But however, in 5 sections, 194B, your casual incomes, 194BA, your online winnings, 194BB, your horse race winnings, simple, your 194B sections, 194N, cash withdrawals, and 194T, your new section for partners, remuneration and interest. In these 5 sections only, the deductee can be resident, non-resident, it doesn't even matter. But in all other sections, the deductee, the person to whom we are paying the amount, the person against whom we are deducting the tax, has to be a resident. Okay, guys, now if the deductee happens to be a non-resident, then there's something called a section 195 that will apply, which is not in your intermediate syllabus. So therefore, in our entire syllabus, the deductee has to be a resident only. Deductee can be a non-resident also, only in these 5 sections. Be very careful about this. So now we are done with our TDS discussion, and now we're going to start discussing about TCS. Let's have a look at this example, that how exactly does TCS even work. Let's say there's a seller, he sold goods to the buyer, okay, and let's say the buyer is going to give 100 rupees consideration to the seller for the goods. Now, along with the consideration, the seller will ask the buyer to pay TCS also, let's say 10 rupees. So total 110 rupees buyer will pay to the seller. Now the seller will keep 100 rupees, and the 10 rupees tax which the buyer has paid, the TCS, the seller will remit it to the government, and when the seller remits it to the government, the seller will tell the government whose tax is it. It is a buyer's tax. Later, the buyer will compute his income, guys. Buyer will compute his tax liability. Let us say buyer's tax liability is 40. Now buyer will not pay full 40 again. What will the buyer say? That government, you have already received 10 rupees on my behalf. So the buyer will take credit of that TCS. Buyer will enjoy TCS credit of 10 rupees over here, and only the balance 30 rupees only will become payable from his end. Understanding? So TCS, tax collected at source. So when the seller is collecting the consideration from the buyer, along with that he will collect TCS as well. Not in every transaction, only in some transactions which we are going to be learning. There are only 4 to 5 TCS sections, guys. So if your transaction is getting covered in those 4 to 5 sections, then only TCS will be attracted for your transaction. Simple, everybody, right? So and one more thing, the main person in TCS will be the seller, because the seller is a collector of tax, and the other party, the buyer will become the collectee of tax. Like for example, when you look at TDS, okay, if you compare TDS and TCS, who is the main person in TDS, guys? The deductor of tax, and in TCS it will be the collector of tax, and the other person in TDS will be the deductor of tax. In TCS it will be the collectee of tax. Okay, whoever is the main person, their TAN number is required. Whoever is the other person, their PAN or Aadhaar, at least one is required. Okay, you got a brief idea about how TCS works, guys? Yes. Now come on, let's enter into our very first section. Our first section in TCS is going to be section 206C 1F, 206C 1F, which talks about motor vehicles and notified goods. Let's have a look at the section. Let's see what exactly has happened over here. 4 conditions, okay? Condition number 1. What is a seller selling? See, we just learned, right? In TCS, the seller is selling some goods to the buyer, and along with the consideration for the goods, seller is collecting TCS also. So in 206C1F, what is the seller selling? The seller is selling either motor vehicles or any other notified goods. Are you repeating along with me? Are you learning with me? What is the seller selling? Either it is motor vehicles or it is any other notified goods. Okay, what are the notified goods? Wait, we'll come to it later. then the selling price per vehicle or notified goods, as the case may be, has to be more than 10 lakh rupees separately. Like for example, if the seller is selling 2 cars to the buyer, then per car has to be more than 10 lakhs. So per item, the value, the selling price has to be more than 10 lakhs. Okay. Then condition number 3, who is the buyer? The buyer has to be a retail buyer, which means the buyer has to be an end consumer. See, end consumer means he is not buying the goods to resell. He is buying the goods for his own consumption. Like if he is buying a car, he is buying for himself, not to resell. Okay, so he must be an end consumer, he must be retail buyer, and seller must be R hijack seller. You know who is R hijack, guys? R hijack means you will trouble only the individual or HUF. Either the preceding previous turnover has to be more than 1 crore or the preceding previous gross receipt has to be more than 50 lakhs. That same point only. So in 2061F, you got the whole situation, right? I have the seller and I have the buyer. The seller is selling goods to the buyer. When the buyer is paying the consideration, along with that the buyer will also pay TCS, guys. Now in 2061F, what are the goods that the seller is selling? Either it is some motor vehicle or it is some notified goods. And the selling price per item is more than 10 lakh rupees, and the buyer is retail buyer, which means he's buying the goods for himself. He's an end consumer, he's not buying to resell. And who's the seller? Seller is an R hijack seller. Okay, if all these conditions are fulfilled, welcome to 2061F. When the seller is collecting from the buyer consideration for the motor vehicle or consideration for the goods, along with the consideration, seller will also collect TCS at what rate? At the rate of 1%. Easy, guys. That's all very simple. 4 conditions. What are the goods? Selling price per item should be more than 10 lakh. Who is the buyer? Who is the seller? Okay, guys. Now comes a question that what are these notified goods? You have to be careful, okay, because these notified goods are going to be applicable first time May 26 examination onwards only. So what are these notified goods? Wristwatch, art piece, antiques, paintings, sculptures, collectibles like coins or stamps, yacht, sunglasses, bags, shoes, home theater system, horses, sportswear. Basically, guys, these are all your luxury goods. Okay, so all of these luxury goods, even for these 2061F will apply. Wristwatch, come on guys, imagine if a wristwatch is worth more than 10 lakh rupees. If a wristwatch is being sold for more than 10 lakh rupees, automatically it becomes a luxury good, right? Then collectibles, art pieces, yacht, sunglasses, bags, handbag costing more than 10 lakh rupees. Of course, it's going to be a luxury bag. So all of these luxury goods will also get covered under 2061F. Okay, guys. Yes. So what are my conditions? Let's summarize now. 4 conditions. Condition number 1: the goods have to be motor vehicles or notified goods. Then the selling price per vehicle has to be more than 10 lakh rupees. Then the buyer has to be a retail buyer, which means he must be an end consumer. And lastly, seller has to be R hijack seller. If all these conditions are fulfilled, 1% TCS will apply at the time of receipt. But however, if the buyer happens to be a public sector company, then this section is not applicable. So there are some sections where the buyer should not be a public sector company. 2061F is one such section. If the buyer happens to be a public sector company, then this section will not apply. Okay, guys. Now comes the OG section of TCS, the main section, the very first section of TCS, 206C1. Now, same logic even over here, guys. I have a seller, I have a buyer. Seller is selling goods to the buyer. When the buyer is paying consideration for the goods, along with that, the buyer will pay consideration also. Same concept. But here, what are the goods? Who is the seller? Who is the buyer? Same questions I will ask once again. So coming back to the basics. Seller is selling goods to the buyer. Listen everybody. Seller is selling goods to the buyer, but what kind of goods? Here the goods are atoms. Now what are these atoms? A stands for alcoholic liquor for human consumption. T stands for tendu leaves. T stands for timber. O stands for any other forest produce. M stands for minerals like iron ore, copper, lignite, and S stands for scrap. So in 2061F, the first section we learned, the goods were motor vehicles or any notified goods. In 2061, we have 6 goods, guys, atoms. A for alcoholic liquor for human consumption, T for tendu leaves, T for timber, O for other forest produce, M for minerals, S for scrap. Repeat last time. A for alcoholic liquor for human consumption, T for tendu leaves, T for timber, O for other forest produce, M for minerals, and S for scrap. So if the goods happen to be any of these goods, then TCS under 206C1 will apply. Okay, guys. Then in that case, when the buyer is paying consideration for the goods, along with that, we will ask the buyer to pay TCS also. Okay. Then even over here, guys, the seller has to be R hijack seller. Same thing. If he's an individual or HUF, then his preceding previous year turnover has to be more than 1 crore, or his preceding previous year gross receipt has to be more than 50 lakhs. So now tell me, what are all the sections where we talk about R hijack? Of course, the R hijack sections. In addition to that, two sections in TCS, guys, 206C1F and 206C1. Here in these two sections, the seller should be fulfilling the R hijack condition. Right, guys? So, you know what is R hijack anyways. Then comes my next point, at what rate TCS will apply. It depends. See, Tendu leaves, highest TCS rate 5%. Then TO2, timber and other forest produce 2%. Everywhere else 1%. Easy to remember, guys. So Tendu leaves, highest TCS rate 5%. Then TO2, timber and other forest produce 2%, and everywhere else 1%. Easy to remember, guys. So in 206C1, condition number 1, goods are atoms. Condition number 2, seller is R hijack seller. Now comes a very interesting condition, the third condition. There's something called as 206C1A declaration, okay. 206C1A declaration means what? First of all, understand. See, this declaration can be given only for atoms, only for these goods, only this declaration can be given. If the buyer is saying that I am not going to resell the goods. If the buyer is saying, I'm not going to trade in these goods, buyer is saying, yes, I purchased scrap, or yes, I purchased minerals, but I'm not going to resell. I'm not going to trade in them. I'm going to use these goods for further manufacturing, for further processing. I'm going to use these goods as raw material, or I'm going to use these goods for generating power. Basically, if the buyer is saying that I am not going to resell these goods, I am not going to trade in these goods. Yes, I purchased atoms, but I'm not going to resell them. I'm not going to, trade in them. I'm going to use them for further manufacturing. I'm going to use them to generate power. Then the buyer can give one declaration to the seller about this. That is called as 206C1A declaration. If the buyer gives this declaration, come on, listen carefully. If the buyer gives this declaration, then no TCS at all. Under any section whatsoever, no TCS at all. Am I saying no TDS also? No. I am saying no TCS at all. Okay. So which means condition number 3 is buyer should not give this declaration, guys. Right? Because if the buyer has given this declaration, then TCS will not apply. So when will 206C1 TCS apply if the buyer has not given this declaration? Okay, so come on, let's summarize now. Condition number 1, what are the goods over here? Atoms. Seller, R hijack seller. Condition 3, buyer should be a person who has not given 206C1A declaration, because if he gives 206C1A declaration, then no TCS at all. And when can he give this declaration? If the buyer is saying that yes, I've purchased atoms, but I'm not going to resell the goods. I'm not going to trade in the goods. I'm going to use them for further processing. I'm going to use them to generate power. If he gives a declaration like that, then no TCS at all. But tell me, guys, can the buyer give this declaration in 206C1F also? No. This 206C1A declaration is only and only for atoms. Okay, so 3 conditions over here. If all these 3 conditions are fulfilled, then for Tendu leaves 5%, then for TO2, for timber and other forest produce 2%, everywhere else 1%. Easy, guys. Yes, and even over here, same thing. The buyer should not be a public sector company. If the buyer is a public sector company, 206C1 will not apply. Let's do one small comparative analysis between these two sections. Come on, guys. In 206C1F, what are the goods we're talking about in 206C1F? We spoke about motor vehicles and notified goods. In 206C1, we're talking about atoms. Then, what is the TCS rate in 206C1F? Only one TCS rate we have 1%. In 206C1, for Tendu leaves it is 5%, for TO2 it is 2%, and for everything else it is 1%. Then in 206C1F, who is a buyer? Here the buyer is an end consumer, which means somebody who is buying the goods for himself, but he should not be public sector company. In 206C1, the buyer should be a person who has not given 206C1A declaration. Because if he gives a declaration, then no TCS at all. And also even over here, the buyer should not be public sector company. Right, guys? Then who is the seller? In 206C1F, the seller is R hijack seller. In 206C1 also, the seller is R hijack seller. Okay. Then in 206C1F, the selling price per item, separately, selling price has to be more than rupees 10 lakhs. But there is no such condition in 206C1. Okay, thorough with my first 2 TCS sections. Multiple revisions also I've given you. Yes, guys. Now come to my third TCS section, 206C1C, the simplest TCS section. Here, listen to me. Very simple. There's a lease or license of toll plaza, mine, quarry or parking lot. Repeat again. Toll plaza, mine, quarry, parking lot. Repeat last time. Toll plaza, mine, quarry, parking lot. So if there's a lease or license of any of these, 206C1C will apply. No limit over here, no condition over here, nothing. Like for example, government is giving you a coal mine on lease. Now you will be paying lease charges to the government, no? So along with the lease charges, you have to pay TCS also. Let's say you're taking some parking lot on lease. Now you'll pay consideration for the parking lot lease. Now along with the consideration, you'll have to pay TCS also. So toll plaza, mine, quarry or parking lot, any lease or license, TCS will apply at the rate of 2%. Okay guys, 2%, and even over here the buyer should not be a public sector company. Okay, this was a very simple section. Toll plaza, mine, quarry, parking lot, lease or license of any of these, 2% TCS will apply. This is 206C1C. Coming to our next section now, 206C1G, the last section in TCS, but the most important section in TCS because heavily amended. It was amended by Finance Act 2024 also, Finance Act 2025 also. So every year in the last 2-3 years, we are seeing amendments over here. So automatically it becomes an extremely important section. Listen to me. We will be discussing this section in two parts. In the first part, you will be getting full FEMA fields only. So the first limb is all about something called as overseas remittance. Like you know, right, in FEMA, we have something called as a liberalized remittance scheme. Under the liberalized remittance scheme, when you make a remittance, like from India, you're sending money to US. So under liberalized remittance scheme, if you send money, then you don't need any RBI approval. So when you're sending money under liberalized remittance scheme, then this TCS 206C1G TCS will apply. Look at this diagram, you will understand. So let us say blue, he's in India, he's sending money to green in US through Western Union, which is an authorized dealer. And this remittance is under LRS. LRS is a liberalized remittance scheme. Now, when you send money from India, when you're sending money to outside India under liberalized remittance scheme, you don't need RBI approval. Without approval itself, you're allowed to send. There's a limit. Up to $250,000, you're allowed to send without RBI approval. So, under this section, if you're making an overseas remittance like this, if it is under LRS, then when you're sending the money, along with the money, the authorized dealer will also collect TCS from you. Now comes a question, at what rate? The rate depends upon how much are you sending and why are you sending. So the TCS rate depends upon the reason why you're sending the money and the amount of money that you're sending. If you're remitting up to 10 lakh rupees, then no TCS at all. For whatever purpose, up to 10 lakh rupees, no TCS. But if you're making a remittance of more than 10 lakh rupees, then I will look at the purpose. If the remittance is relating to education or if it is relating to medical purposes, then 5% TCS, 5% of the excess. If the remittance is for any other purpose, then 20% TCS, 20% of the excess. See guys, I'll again draw one small black box for you over here. The question, the section says 20% of the excess. See, where have you seen this word excess before? The first time you saw this word excess was in section 194N guys, TDS on cash withdrawals. Second time you saw excess was in section 194Q, your TDS on goods. And now you're seeing the word excess here in section 206C1G. So if you're going to remit money up to 10 lakh rupees, then the authorized dealer will remit it just like that without even collecting any TCS from you. But if you remit more than 10 lakh rupees, then whatever is the excess above 10 lakh rupees, on that TCS will apply. At what rate? It depends on the purpose. If you're remitting with respect to education or medical purpose, then 5% TCS. If the remittance is for any other purpose, then 20% TCS. But percentage of what? Percentage of the excess. Okay, excess above 10 lakhs. Now listen. This 10 lakhs limit, and one more thing, if the remittance is for education and if it is remitted out of section 80E loan, like for example, let's say you're going to study in Oxford University in London, okay, so you took an education loan in India. Now from that education loan, you're remitting money to the university. So from India, you're making an overseas remittance guys. You're remitting money to the University of Oxford in London. You are remitting money out of the education loan. So if the remittance is out of education loan, then even though it's an overseas remittance, still TCS under this section will not apply. Okay, so come on, let's do one quick revision of the section 206C1G, two limbs. We're learning the first limb right now. We're talking about overseas remittance where from India you're remitting money to outside India. Okay, if you're remitting under LRS, then the authorized dealer will not only collect from you the money to be remitted, they will also collect TCS from you. But if you're remitting up to 10 lakh rupees, they will not collect any TCS from you. If you're remitting more than 10 lakh rupees, then whatever is the excess above 10 lakh rupees, on that excess only they will collect TCS from you. At what rate? If you're remitting for the purpose of education or medical purpose, then 5% TCS they will collect from you. Any other purpose, 20% they will collect from you. But however, if you're making remittance out of ATE education loan, then even if it is more than 10 lakh, still it's okay, enjoy. No TCS at all. Okay guys. Then listen. This 10 lakh limit is aggregate, not separate. I'll tell you what this means. Like for example, let's say I sent 11 lakhs for medical treatment on 1st September 25. So now wait, I need some space. Listen, I sent 11 lakh rupees for medical treatment on 1st September 25. So more than 10 lakh rupees guys. So what is the excess above 10 lakh? 1 lakh is the excess. On this 1 lakh, 5% TCS. Why 5%? Education or medical purpose, 5%. So 1 lakh into 5% will be 5,000 rupees. This much TCS will apply. Then same person, me, I sent 1 more lakh for some other purpose a little later on 12th December 25. Now again will you apply 10 lakh limit? No. Each person will get 1 10 lakh limit for 1 year. So in that 1 year, whatever remittance you do, whatever overseas remittance you do, up to 10 lakh you can do without TCS. That's why I'm saying 10 lakh is aggregate limit over here, not per transaction. I can do 4 transactions, 5 transactions, 10 transactions, any number of transactions in a year, per annum, up to 10 lakhs I can remit without TCS. Next year, again 10 lakhs I can remit without TCS. So the limit will keep getting reset every year. Okay, so I sent 11 lakhs. So I sent more than 10 lakhs. So up to 10 lakh, no TCS. Excess above 10 lakh is 1 lakh. On that 1 lakh TCS. Then again I sent 1 lakh. On this 1 lakh there will be TCS. Why? I already enjoy 10 lakh exemption. So after 10 lakh, whatever I remit on that TCS will apply. Other purpose. So therefore 20% TCS. So 20,000 rupees TCS they will collect from me. Okay guys, now comes a very interesting discussion that the remitter will have to give a declaration to the authorized dealer about all the prior remittances completed during that particular year. Because all the remittances which have already been done during the year, even that will be considered in making this 10 lakh calculation. Like if I come to the same example, okay, let's say 11 lakhs we transmitted through Western Union. It was more than 10 lakhs. So therefore Western Union will collect TCS 5,000 guys on the excess. Now for this 1 lakh for the second transaction, let's say I came to Thomas Cook. So when I come to Thomas Cook, I am supposed to give them a declaration that listen, through Western Union I have already remitted 11 lakhs. I should tell Thomas Cook. So Thomas Cook will know now that okay fine, Anushree's 10 lakh limit is already breached. So which means now we have to collect TCS from her. So then on 1 lakh also they will collect TCS from me. Otherwise, see if I don't give this declaration, then according to Thomas Cook, okay 1 lakh only, less than 10 lakhs, they will not collect TCS from me. So the income tax department wants to avoid that situation. That is why they're telling the assessee, listen, it is your responsibility. When you come for the second transaction now to Thomas Cook, you should let them know that in the past you have already remitted 11 lakhs. So then Thomas Cook will think, oh, she has already remitted more than 10 lakhs. So 10 lakh exemption is already over for her. So now every remittance for her TCS will apply. So then on 1 lakh correctly they will collect TCS from me. You got the logic right. So this was your 2061G first limb. Now coming to a second limb. Second limb is very simple guys. It's like one baby transaction only. Here we're talking about overseas tour package. First of all, it is overseas. I'm not going to Shimla. I'm going to Switzerland. So it is overseas. It is foreign. It is tour package. It is not ticket. It is tour package, which means I want to go to Switzerland. I am going to make my trip first. I am buying from them one tour package. Tour package means I am buying ticket also, I am buying hotel stay also, both I am buying from Make My Trip. Understanding guys? So overseas tour package means I want to go on a foreign trip. And for that, for example, I come to Make My Trip and I buy a tour package, which means not just travel ticket, even stay. Now for this transaction, I have to pay them consideration. I bought Switzerland tour package from them. Now I have to pay them consideration. Along with the consideration, they will ask TCS also from me. Up to 10 lakhs. If the consideration is up to 10 lakhs, 5% TCS they will collect from me. If the consideration is more than 10 lakhs, 20% TCS they will collect from me. Now listen. Carefully listen. In overseas remittance, the first limb, up to 10 lakhs was no TCS. If I remit more than 10 lakhs, on the excess only there was TCS. Sometimes 5%, sometimes 20%. Is it same to same over here? Totally different. Here, whether the consideration is within 10 lakhs, whether it is more than 10 lakhs, TCS will apply. Even if it is within 10 lakhs, TCS will apply. Only thing is TCS rate will be less, that's all. Up to 10 lakhs, TCS is 5%. More than 10 lakhs, TCS is 20%. But are you noticing, in overseas remittance, up to 10 lakhs, there was no TCS. So in overseas remittance, 10 lakhs was like your exemption limit. Here, no exemption. If you're going to buy overseas tour package, be ready to pay TCS. Okay guys, look at one example. Let's say I purchased one tour package for 12 lakh rupees. So it is more than 10 lakhs guys. So on the first 10 lakhs, only 5% TCS, 10 lakhs, 5%. What is the excess above 10 lakhs? What is above 10 lakhs? 2 lakhs. On that 2 lakhs, 20%. So it'll be like one slab rate. Up to 10 lakhs, 5% TCS. More than 10 lakhs, whatever is the excess on that 20% TCS. Okay guys, now listen. Look at this concept test. Overseas remittance, the first limb. Can I say 10 lakhs is exemption limit? True or false? Can I say up to 10 lakhs no TCS? Yes guys, it's going to be true. Up to 10 lakhs no TCS in overseas remittance. Only if I remit more than 10 lakhs, only then whatever is the excess on that TCS. But overseas tour package, what we are just now learning, the second limb, there also can I say up to 10 lakh no TCS? No. Up to, whether it is within 10 lakhs, whether it is more than 10 lakh, TCS will apply. Only thing is TCS rate will change. Up to 10 lakhs, only 5% TCS. More than 10 lakhs, 20% TCS. That's all. Okay guys, this was 206C 1G, your fourth section of TCS. So totally how many sections guys? Totally we have 4 sections only in TCS. What are the 4 sections? Tell me. The first section we learned is 206C 1F. This applies to motor vehicles and to notified goods. Then we learnt about 206C 1, which applies to atoms. Then we learnt about 206C 1C, which applies to lease or license of your toll plaza, mine, quarry or parking lot. And finally we learnt about 206C 1G. This section has 2 limbs. First we talk about overseas remittance and then we talk about overseas tour package. That's all guys. Only 4 sections when it comes to TCS. Okay, now listen. Do you remember in TDS we had something called as 206AA? In case you have forgotten, let me remind you. In 206AA we had learned this. By the way, this was relating to TDS. So here we had learned that the main person in TDS is a deductor. Deductors TAN number is required. The other person is the deductee. The deductee has to give PAN or Aadhaar, give at least one. But if the deductee neither gives PAN nor gives Aadhaar, then welcome to 206AA. In 206AA, the TDS rate will change. Whatever is the applicable rate of the section or 20%, whichever is higher, this will become the new rate. But however, in 194Q, there it will be whatever is the applicable rate of 5%, whichever is higher. Able to recall? Just like how you have 206AA in TDS, similarly in TCS we have 206CC. That is what we are going to be learning now. So in 206CC, TCS section. So in TCS, who is the main person guys? In TCS, the main person is a collector. The collector of tax. His TAN number will be mandatory. Who is the other person? The other person will be the collectee of tax, the person who is paying the TCS. His PAN or Aadhaar is mandatory, give any one. But if the collectee is neither giving PAN nor giving Aadhaar, welcome to 206CC. 206CC says the rate will be whatever is the rate, 2 times of that, 2 times the rate. Like this you don't have in 206AA. 206AA simply says rate or 20%, whichever is higher, simple story. But here they are saying 2 times the rate or 5%, whichever is higher. But we also have a maximum limit of 20%. I'll tell you why this maximum limit is there. Just now we learned 206C1G. In 206C1G we have 20% TCS also. So 2 times the rate will become 2 times 20%, 40% or 5%, whichever is higher. 40% will become higher. So TCS, we don't want so much TCS and all. That is why we are putting one maximum limit that in any case, it should not exceed 20%. Getting my point? So 2 times the applicable rate, or 5%, whichever is higher, but maximum 20%. But this part you can ignore, guys, because 206C1H has been removed. That section itself has been removed from the Income Tax Act. So 206CC says 2 times the rate or 5%, whichever is higher, maximum 20%. Guys, I think in the checkmate book also this part will be there. Remove it, okay? That's it. So this was our entire discussion on TCS along with 206CC. So with this, we are done with TDS and TCS in a detailed manner. In around 2.5 hours, we were able to revise the entire set of sections. If you've reached till here and if you found the video even one bit beneficial, please ensure you let me know. Now, right after this, we begin with return of income. In return of income, guys, please ensure that you don't compromise even one bit, because I've not compromised in this revision video. The thing is, your last question is going to be from return of income. It's like a sure shot 4 marks question, and it's not going to be very complicated. If I can tell you that, around 45 minutes can assure you 4 marks, I think it's a very good deal. Right, guys? So do this return of income discussion properly. The non-negotiables for you in your return of income chapter would be your 139(1) due dates, which you already are aware of. Then who has to file income tax return, the whole list that we will be learning, the 11 situations. Then please ensure you do properly the verification of ITR, that who has to verify ITR. Then 139AA, the Aadhaar discussion in a very detailed manner you will find in this video. And of course, TRP, tax return preparer, and updated return. These are your non-negotiables, so go all out, guys, given your 200% and get done with return of income as nicely as you got done with TDS and TCS. Point number 1, 2 concepts I'm comparing: belated return and revised return. See, belated return is nothing but filing the return late, and revised return is nothing but I have filed the return, now I found a mistake, so I want to revise the return. So yes, I can file late return, I can file belated return, yes, I can also revise the return, both are allowed. And for both, the time limit is the same. If you want to file late return, latest by when you can file. If you want to revise your already filed return, till when can you revise? Time limit for both is the same. The time limit is 3 months before the end of the assessment year. Like for example, for our examination, our previous year is 25-26, guys. Our assessment year is 26-27. So end of the assessment year will be 31st March 2027. So minus 3 months. 3 months before the end of the assessment year will be 31st December 2026. So this will be the last date. Whether if you want to file your income tax return, ideally you should file on time. But if you're not able to file on time, it's okay, you can file late. But latest you'll have to file by 31st December 2026. Then if you want to revise your already filed return, you can revise. You have to revise latest by 31st December 2026. Okay. So belated return, revised return, for both time limit is the same. Time limit is 3 months before the end of the assessment year. That is 31st March 2027 minus 3 months. That is 31st December 2026. Okay, guys. My first point. Now listen. Let's talk a little bit more about revised return. I filed my ITR on time. Can I revise that return? Yes, I can revise. I filed my return late. Can even late return be revised? Yes, even return filed on time can be revised. Even late return can be revised. I have already revised the return. Can I once again revise? Yes, guys. In simple words, any kind of return, any number of times you can revise. No tension. Only one tension. What tension? You have to revise within this date. Okay, guys. Then listen to me. Are the following situations allowed? This is interesting, okay. If my original return is filed in 115 BSE, can I revise and say, when I revise the return, can I say, no, now I will follow normal regime? I can't do that. But if my original return is filed in normal regime, and if I revise my return and if I say I will follow 115 BSE, government will be more than happy. Okay, so this was a discussion about belated return and revised returns. Simple discussion only. Yes, you can file late return also. Yes, you can revise your return also. For both, time limit is the same. 3 months before the end of the assessment year, that is 31st March 2026. You can revise any return, any number of times you can revise. If your original return is default regime, your revised return can't be normal regime. It has to be default regime only. But if your original return is normal regime, your revised return can be default regime. That is allowed. Now comes a very important point, one of the most important concept from this chapter, guys. What will happen if I file my ITR late? Yes, I can file my ITR late, but if I file my ITR late, there will be consequences, and there will be 6 consequences. Listen to me. Consequence number 1. You cannot carry forward current year loss. Remember, guys, set off and carry forward chapter. You can do intrahead. You can do interhead. Earlier year's loss you can bring forward. Earlier year's loss you can also carry forward to the next year. But current year loss you cannot carry forward. However, current year loss from house property, current year unabsorbed depreciation, you can still carry forward even if you file ITR late. But otherwise, other losses you cannot carry forward. Then comes the second consequence. This also you know. In Chapter 6A, Part B you can claim. But Chapter 6A, Part C you can claim only if you file ITR on time. So if you file your ITR late, Chapter 6A, Part C you cannot enjoy. Then comes the third consequence. If you file your ITR late, Section 234F fees you will have to pay. This is a new point for you. How much 234F fees you'll have to pay depends upon how much your total income is. If your total income is within 5 lakhs, then 1000 rupees you'll have to pay. If your total income is more than 5 lakhs, then 5000 rupees fees you will have to pay. This is 234F fees. Easy to remember. F for fees. Fees for late filing of ITR. Okay. Then you'll also have to pay 234A interest. See guys, we have 3 interests. Okay. 234A, B and C. Each interest is for different reason. 234B and C you will be learning in your advanced tax chapter, in your next chapter. Right now I am talking about 234A. 234A comes into the picture when you file your ITR late. So whatever is a delay period, for the delay period 1% per month or part thereof interest you will have to pay under 234A. Then comes your fifth point, something which you had learnt with from me long back in basic concept chapter. If you file ITR late, you cannot opt out of default regime. In simple words, I'll draw one small table for you. 2 possibilities. Let's say default regime and normal regime. Now, what if I filed my ITR on time, within 139 date I filed? Then I can choose default regime, or if I want to opt out, I can opt out, I can follow normal regime. But if I file my ITR late, guys, then normal regime is not even an option for me. It has to be in default regime only. Getting my point? So if I file my ITR late, then I will have to be under default regime only. I cannot opt out. This is another consequence. And then in your chapter 6, I had told you that if you file ITR late, 10AA tax holiday you will not get. 10AA you will enjoy only if ITR is filed on time. So if you file your ITR late, 6 consequences, guys. Consequence number 1, you cannot carry forward current year loss. Consequence number 2, chapter 6A part B you can enjoy, but part C you cannot enjoy if you file ITR late. 234F fees you will have to pay how much? The amount depends upon your income. If income is within 5 lakhs, then 1000 rupees. If income is more than 5 lakhs, then 5000 rupees. Then the fourth consequence is 234A interest you will have to pay at 1% per month or part thereof, whatever is a period of delay. For the period of delay, you will have to pay 1% per month or part thereof. Then if you file your ITR late, you cannot follow normal regime. It has to be default regime only. And lastly, 10AA tax holiday you will not get under if you file ITR late. Okay, 6 consequences. Now have a look at this situation in front of me. My 139.1 due date was, for example, 31st July. I filed my ITR on time, guys. 1st July itself I filed my ITR. Then I revised my ITR on 30th December 26. So here if you notice, I filed my ITR on time. If I want to revise ITR, the last date possible is 31st December 26. And before 31st December, on 30th December itself, I revised my ITR. But in the revised ITR now, I am declaring business loss of 1 lakh. When in my revised ITR. Now question is, can I carry forward this loss? The question arises because, see, had I declared this loss on 1st July itself, you would have said, okay, loss is declared before 139.1 date. You will let me carry forward. But now I am declaring my loss in the revised return on 30th December 26. See, no doubt I am declaring the loss before my revised return due date. But I am declaring the loss after 139.1 date, which means I am declaring loss after my return filing due date. Then also will you let me carry forward the loss? First of all, question you should understand, then only we will come to the answer. I filed my original return on 1st July. On time I filed. Then I revised the return on 30th December 26. Yes, I revised within revised return due date. But I am revising it after 139.1 date. I am revising it after return filing due date. In that revised return, I am declaring loss. Can I carry forward the loss? The answer is yes. I'll tell you the reason why. The logic is very simple. Remember, whenever you revise your return, the revised return replaces the original return. Which means, when I revise the return on 30th December 26, and in this revised return, when I declare business loss of 1 lakh, it will be as if I have done all this on 1st July itself. When did I file my original return? On 1st July, no. So it will be as if I have done all this on 1st July itself. The revised return will always replace the original return. Okay, so therefore, even if you declare losses in the revised return, it is totally fine. Okay, guys, this was an interesting discussion about what will happen if you file the ITR late. So, two concepts we've learned: belated return, revised return, and what will happen if you file your ITR late. Now comes self-assessment. Our whole Income Tax Act is based on this concept of self-assessment. Now, what do you mean by self-assessment? Very simple, guys. See, in Income Tax Act, we don't wait for the assessing officer to come, stand on our head and say, listen Anushree, this is your income, this is how much tax you have to pay. We don't wait for the Income Tax Department to come and give us instructions. We ourselves, before the return filing due date, we ourselves compute our income. We ourselves compute how much tax we have to pay, and we don't wait for some notice to come. We ourselves go and voluntarily pay the tax, guys. That is called a self-assessment. Assessment by assessee himself. So in self-assessment, assessee himself computes his income. Assessee himself computes his tax liability, his tax payable number, files a return on time and remits the tax to the government. This is the concept of self-assessment. So whatever tax you're finally remitting to the government, that becomes your self-assessment tax because you yourself did the computation. You're understanding? You're not waiting for somebody else to come and assess your income. You are yourself assessing your income. You are yourself assessing your tax. Assessment means computation. You are yourself doing your computations and you're remitting the tax to the government. So whatever tax you remit to the government becomes your self-assessment tax. Okay. Then comes verification of ITR. Now, if this comes in the examination, you will thank your stars. It's a very, very simple concept. But if it comes in the examination, it will be straight away for 4 marks. We just have to know over here that who is going to verify the ITR. It depends upon who is the assessee. If assessee is individual, he himself will verify. Or if he is unable to verify, like for example, let's say he is not in India, he is traveling. So he is unable to come and verify. In that case, his agent can verify on his behalf. Or let's say he is of unsound mind, then in that case, his guardian will verify on his behalf. So if individual assessee himself, if he is unable to verify because of whatever reason, his agent can verify on his behalf. If he is of unsound mind, his guardian can verify on his behalf. Okay. Then if assessee is HUF, the Karta is supposed to verify. But because of whatever reason, if the Karta is unable to verify, any other adult member of the HUF can verify. Whether male, whether female, any adult member can verify. Okay. If assessee is a company, the managing director of the company is supposed to verify. But if the managing director is not able to verify because of any specific reason, then in that case, any director also can verify. But if the company is going through the winding up process, that is if the company is in liquidation, then the liquidator has to verify. Okay. Then if the assessee is a partnership firm, the managing partner, the main partner of the firm should verify. But if he is unable to verify because of any reason, any other major partner, any other partner who is 18 or 18 above can verify. Then if your assessee is a LLP, limited liability partnership, the designated partner is supposed to verify. But if he is unable to verify because of any reason, then any other major partner can verify. If assessee is a local authority, then principal officer should verify. Political party, CEO of the political party should verify. AOP or BOI, any member can verify. Okay guys, so this is about verification. Then comes our next discussion that who has to file ITR. Does everybody have to file ITR? The answer is no. Only if you fit under any of these situations, only then you have to file ITR. This is again extremely important. Every company, whether it's a dormant company, whether it's a small company, whether it's a listed company, unlisted company, public company, private company, 1% company, even Section 8 company, doesn't matter. Every company has to file ITR, it is mandatory. Similarly, every partnership firm, every LLP has to file ITR, it is mandatory. Then for whom option is there? Only individual HUF, AOP, BOI, AJP. For these persons, only if these persons come under any of these 11 situations, only then they have to file ITR. Getting my point? Every company, mandatory, file ITR. Every firm, mandatory, file ITR. But individual HUF, AOP, BOI, AJP, only if they come under these 11 situations, they have to file ITR. What are they? The first situation, I will look at your GTI, not total income, GTI. GTI, I will add back the 54 series exemptions in capital gains. So GTI plus 54 series exemption, I will see what number we get. If it is more than basic exemption limit, that person has to file ITR. First situation. Second situation, if you are an ROR, but if you have a capital asset outside India, like for example, you are having a house outside India, or you are holding shares of a foreign company. So you are an ROR and you are having a capital asset outside India, then you will have to file ITR. What if I am an ROR and if I have a car outside India? Now car is not capital asset, so therefore I will not come under the second bucket. So second bucket, you must be having capital asset outside India. Third bucket, you're in ROR and you must be having an agent outside India. Agent outside India indicates you must be having some signing authority outside India. There must be somebody outside India who can sign on your behalf. Some agent you must be having outside India. First three clear? Come on, tell me the first three. In the first point, assessee's GTI, add back 54 series exemption is more than basic exemption limit. Second situation, assessee is an ROR and he has a capital asset outside India. Third situation, assessee is an ROR and he has an agent outside India. Now coming to a fourth situation. In the fourth and the fifth situation, in both of these, we are depositing money into bank account. So if assessee's total deposit in current account is more than 1 crore, or if assessee's total deposit in the savings account is at least 50 lakhs, if any of these two situations are applying, then assessee will have to file his ITR. Current account deposit should be more than 1 crore. Savings account deposit should be at least 50 lakhs. Be careful about the sign over here, okay? Then comes 6th and 7th, very commonly asked questions in the examination. If total electricity expense in the previous year is more than 1 lakh, or total foreign travel expense is more than 2 lakhs. Now see, foreign travel expense, not necessarily you only should be going on the foreign travel. Maybe your family is going, or maybe your friends are going. Basically, you are the one who is incurring the expense, okay? Who is traveling doesn't matter. You are the one who is incurring the expense more than 2 lakhs. So these are your expenses. Electricity expense more than 1 lakh, foreign travel expense more than 2 lakhs, okay? Then if you're carrying on a business and the turnover of your business is more than 60 lakhs, or if you're carrying on a profession and the gross receipt of your profession is more than 10 lakhs, in all these cases you will have to file your ITR. Then 10th and 11th situation are about TDS TCS credit. If you're a senior citizen or a super senior citizen and your TDS TCS credit is at least 50,000, or if you're not a senior citizen but your TDS or TCS credit put together is at least 25,000, so if you fit in any of these situations, you will have to file ITR. See guys, company, you will not check all this. Firm, you will not check all this. Every company, every firm has to file ITR. This checking of 11 situations is only for individual HUF, AOP, BOI, AGP. So if they ask you a question that whether assessee has to file ITR or not, you will think about all the 11 situations, only then you will conclude. Now comes our next discussion, 139 AA, quoting of Aadhaar number. See guys, we have to interlink our PAN number and our Aadhaar number. Basically, the income tax department should know that for this PAN, this is the Aadhaar. For this Aadhaar, this is the PAN. We have to interconnect our PAN and Aadhaar. So for that, the Income Tax Act says that we have to mention our Aadhaar number mandatorily in 2 places. Number 1, whenever you make an application for PAN, like for example, I don't have PAN number. I want PAN number. So I will fill one application that requesting the income tax department, please allot one PAN for me. In that application, I have to put the Aadhaar number mandatorily. Then number 2, in the income tax return, every year I will file the income tax return, I have to mention the Aadhaar number. So every person has to mandatorily quote their Aadhaar number in 2 places. Number 1 in the PAN application and number 2 in the ITR. Now there are some people, however, for whom Aadhaar is not applicable only. So for those people, of course, this concept itself will not apply, guys. Are you listening to me? Aadhaar is not applicable for some people. So for those people, if they don't even, if Aadhaar is not even applicable for them, then they can't even have an Aadhaar. And if they don't even have an Aadhaar, then there's no possibility of interlinking PAN and Aadhaar. Now, who are those people for whom Aadhaar is not applicable? Number 1, individuals who live in Assam, Meghalaya and Jammu and Kashmir. In these 3 states, guys, Aadhaar has not come full-fledged. The government has not done the procedures full-fledged. So therefore, there is a delay over here. So therefore, in these 3 places, it is not possible for every person to have an Aadhaar number right now. So for these persons, it is not mandatory to link their Aadhaar with their PAN. Who are the people? Persons who are living in Assam, Meghalaya or Jammu Kashmir. Then non-residents. Even for them, Aadhaar, it's not mandatory for them to have Aadhaar. Then an individual who is at least 80 years. And lastly, assessees who are not citizens of India. So for these 4 people, they may not have Aadhaar number. So if they don't have Aadhaar number, we can't force them to link their Aadhaar with their PAN. So this section itself will not apply to these 4 people. People who live in Assam, Meghalaya, Jammu, Kashmir, non-residents, individuals who are at least 80 years and persons who are not citizens of India. Okay guys. Now coming to my next point, this is an interesting point. Okay, listen carefully. So earlier we had 2 options, guys. We know very well in our PAN application and in our ITR, in both of these places, we also have to mention our Aadhaar number. But what if I don't have Aadhaar number, guys? It's okay, no tension. Go apply for Aadhaar. When you apply for Aadhaar, it will take some time for your Aadhaar number to come, but immediately they will give you enrollment ID. That enrollment ID will be given to you immediately. So the law said earlier that if you don't have Aadhaar number, it's okay. You go apply for Aadhaar, you will get enrollment ID. You mention enrollment ID in these documents. then it will take some time for Aadhaar to come, but once Aadhaar comes, then you inform the department what your Aadhaar number is. That option was there for us earlier. But with effect from 1st October 24, this option of mentioning enrollment ID has been discontinued. So now only one option we have, and that is in the PAN application and in the ITR, we have to put the Aadhaar number only. The option that we could have put the enrollment ID, that option itself has been removed. And wait people, listen, all those of you who had exercised this option of mentioning enrollment ID in these documents, by now you would have received your Aadhaar number. So inform your Aadhaar number to the prescribed authority. By 31st December 2025, inform your Aadhaar number to the prescribed authority. So 3 dates we have, guys. First of all, we have 31st March 2022. By this date, ideally, we should complete the linking of your Aadhaar number and your PAN number. Then second date, if at all you were having option of mentioning enrollment ID, but 1st October 2024 onwards, that option of mentioning enrollment ID in these two documents, that option is discontinued. Third date, earlier, before 1st October 24, if you had mentioned your enrollment ID in these documents, then by now you would have received PAN. So by now you would have received Aadhaar number. So ensure you inform your Aadhaar number to the prescribed authority latest by 31st December 2025. 3 dates we have over here. Okay guys, now listen, what will happen if I don't follow this section? What will happen if I don't link my PAN with my Aadhaar? I'm supposed to link by which date? By 31st March 2022, I'm supposed to link. What will happen if I don't link by that date? Then what are the consequences? Severe consequences, guys. Consequence number 1. My PAN itself will become inoperative. See, they will check for which PAN numbers there is no Aadhaar linked. Those PAN numbers itself will become inoperative. But when? The PAN will become inoperative only on 1st July 23. See guys, the interlinking of PAN with Aadhaar is to be done by 31st March 2022 we learned. But the consequence is happening only on 1st July 23. Indirectly, we are getting so much more time to interlink our PAN with Aadhaar, because consequences will start only on 1st July 2023. So if you don't interlink your PAN with your Aadhaar, then your PAN will become inoperative on 1st July 2023. Consequence number 1. Consequence number 2, you will not get income tax refund and all. You will not get interest on income tax refunds also. And number 4, guys, in TDS and TCS, 206AA and 206CC will start applying to you. Now let me help you understand this point. This is a very interesting point. With respect to this point, we have an amendment as well. So let's try to understand this. Before we take this up, till here everything is clear, right? First we learned you're supposed to mention your Aadhaar number mandatory in 2 places. Then the section will not apply for 4 people. Then you're supposed to do this interlinking of Aadhaar with your PAN latest by 31st March 2022. Then 1st October 24 onwards, you don't have the option of mentioning enrollment ID. And then if you had mentioned enrollment ID earlier, by 31st December 25, inform your Aadhaar number to the authorities. Now we're learning what are the consequences, what will happen if you don't interlink your PAN with your Aadhaar. Consequence number 1, your PAN will become inoperative when? On 1st July 23. Consequence number 2, you will not get refund of income tax. Consequence number 3, you will not get interest on income tax refunds. Now comes my consequence number 4. Listen to me carefully, okay? I'll explain this concept to you over here. Let's imagine one situation. Let's take TDS example, then I'll give you TCS example. Let's say there's a tenant. This tenant has to pay rent to the landlord. Okay, 194I TDS is applicable, let us say. So the tenant becomes the deductor of tax and the landlord becomes the deductee of tax. Okay guys, now let's say 194I TDS is applicable, and in 194I 10% is your TDS rate. Okay guys, now what has happened is the landlord, our whole focus right now is on the landlord. This landlord, he has not linked his PAN with his Aadhaar. So because he has not linked his PAN with his Aadhaar, by 31st March 2022, on 1st July 2023, his PAN has become inoperative. PAN has become inoperative means it is as if the landlord is not having PAN number. Okay, but he's having Aadhaar number, let us say. But even his Aadhaar is useless from income tax department point of view, because his Aadhaar has not been linked with his PAN. So they don't care about his Aadhaar number also. See, Income Tax Act is okay with your Aadhaar number only if your Aadhaar is linked with PAN. No, if your Aadhaar is not even linked with PAN, it's just another number for the income tax department. They don't care about the number now. So the landlord is in a situation where he has PAN, but PAN has become inoperative. He has Aadhaar number, but his Aadhaar number is useless for the income tax department because his Aadhaar is not linked with PAN. This is the situation. Now, in TDS, if you remember, we had learned section 206AA, guys. 206AA says, in TDS, the main person is a deductor. Deductors, which number you need? Deductor stand number you need, tax deduction and collection account number. The other party is deductee. Deductee in our example is landlord. Deductee, PAN or Aadhaar, give at least one. But if the deductee neither furnishes PAN nor furnishes Aadhaar, then 206AA will apply. According to 206AA, the TDS rate will change. Whatever is the applicable rate, or 20%, whichever is higher, that will become the revised rate, guys. So this is the exact situation which we have over here. The main person is tenant, his TAN number is required, the landlord is a deductee, his PAN, Aadhaar, both are invalid now. He is neither able to furnish PAN nor he is able to furnish Aadhaar. So 206AA will apply. So what will become your rate now? Either 20% or what is the rate? Applicable rate 10%. So 10% or 20%, whichever is higher. Of course 20% will become the TDS rate. So this will become a big consequence, guys, because if this section was not there, then against the landlord, tax will be deducted only at 10%. But because of the PAN and Aadhaar becoming invalid over here, because he is not able to furnish his PAN, also not able to furnish Aadhaar, 206AA is applying, and because of that 20% TDS will be deducted against the landlord. So this will become your consequence, that if you don't interlink your PAN with your Aadhaar, your PAN will become inoperative, your Aadhaar will become useless for the department. Now you will be in a situation where 206AA will apply in TDS, and because of that the TDS rate will increase. So earlier the tenant would have deducted only 10% tax against you, but now because of all this applicability, the tenant will deduct 20% tax against you. So the TDS which is deducted against you will increase. Same thing in TCS, guys. Same thing in TCS. We have 206CC. In 206CC, if the collectee is not giving PAN Aadhaar, then 206CC applies, because of which the TCS rate will become 2 times the rate or 2 times the rate or 5%, whichever is higher. So same thing in TCS also, that if you don't interlink your PAN with your Aadhaar, your PAN has become inoperative, your Aadhaar is useless for the income tax department. Now the persons who are collecting tax from you, they will collect tax from you at a higher rate applying 206CC. Just like how in TDS, the tenant applying 206AA will deduct tax from you at a higher rate, same way in TCS, applying 206CC, the seller will collect tax from you at a higher rate. Okay, guys. Now listen, this is a big consequence. The rate at which others deduct tax from us, the rate at which others collect tax from us, that rate itself is increasing. It's a big, huge consequence. That is why they have given some relief. They've made one small amendment. Listen to me. There are 2 points in the amendment, very simple points. Listen to the logic. The amendment says, listen, if this rent transaction in our example has happened anywhere between 1st April 2025 to 31st July 2025. If the transaction has happened between this period, okay, then listen, tenant. We are focusing on the tenant now. Listen, tenant. Yes, we know landlord, his PAN has become inoperative and his Aadhaar is not valid right now from income tax point of view. So therefore you want to apply 206AA. But wait, tenant. Let's give the landlord some time. Let's give him time till 30th September 2025. If the landlord is able to take corrective action, that is, if he is able to interlink his PAN with his Aadhaar within the state, and if he is able to make his PAN operative again on or before this date, then in that case, let's not apply 206AA. Getting my point? So because of the amendment, we are kind of giving some relief to the deductee, because we know that this is a big, huge consequence. So we're telling the deductee, okay, fine, we will give you some time. Within this time, you ensure that you interlink your PAN with your Aadhaar. You ensure your PAN has become operative again within this time. If you're able to do that, then the deductor will not apply 206AA. They will deduct tax from you at 10% only. Okay, guys, then there's one more point. 2 points I was telling you. This is the first point. Then what if the transaction happens after 31st July 25? If the transaction has happened after 31st July 2025, then we will see what is the month in which the transaction happened. Like for example, let's say the transaction happened on the 1st of December 2025. Okay, and the landlord is a person who did not link his PAN with his Aadhaar, so PAN became inoperative and Aadhaar is useless. So tenant wants to apply 206AA. But wait, tenant, let's give the landlord some time. See, what is the month in which the transaction happened? December. What is the end of December? 31st December 2025. To this date, add 2 months. If you add 2 months, you will get 28 February 2026. So by 28 February 2026, if the landlord is able to take corrective action, interlink his PAN with his Aadhaar, and if he is able to make his PAN operative again by 28 February 2026, then we will not apply the section. Then in that case, you will deduct tax at 10% only. Okay, so if the transaction happened in this period from 1st April 2025 to 31st July 2025, then we will give time till 30th September 25. If the transaction has happened after 31st July 2025, then we will give 2 months time from the end of the month in which the transaction happened. By that date, if you're able to make the PAN operative, then the consequence of 206 AA, 206 CC and all will not apply. Getting my point, guys? So this is about your another important point. And one more thing, guys, one more thing. If you don't link your PAN with your Aadhaar by 31st March 2022, if you link your PAN with your Aadhaar after that only, yes, you can link. Like today also I can go and link. But I'm linking after the due date, after 31st March 2022. So some consequence I will have. I will have to pay 234H fees of 1000 rupees I'll have to pay. So once I interlink my PAN with my Aadhaar, my PAN will become operative again. Within 30 days, it will become operative again. Okay, this is our entire section of 139 AA. Now coming to my next concept, mandatory quoting of PAN. There are some transactions where you have to mention your PAN number. It is mandatory. What are we learning? There are some transactions in which you have to mention your PAN number. Like for example, like I told you, when you're opening a demat account, you have to mention your PAN number. When you're opening any bank account, whether current account, whether savings account, you have to mention your PAN number. When you're applying for a credit card, you have to mention your PAN number. Then if you buy or if you sell any vehicle other than two-wheeler, if you buy or sell any vehicle like a car or a truck or a van, any vehicle, if you buy or sell, you have to mention your PAN number in the transaction. So in all of these transactions, it is mandatory for you to mention your PAN number. First, for you understood, opening a demat account, opening a bank account, applying for credit card, and sale or purchase of any vehicle other than two-wheeler. Okay, this is my first bucket. Then comes my second bucket. If I want to make an FD, or if I want to make a time deposit, both are the same, guys. FD, time deposit, term deposit, they're all the same. If I want to make an FD with a bank or with a cooperative bank or with a post office or with NBFC or with Nidhi company, wherever, guys, if I want to make an FD and if the value of the FD is more than 50,000, or let us say I have made 6 FDs, each FD is of 1 lakh each. So the total FD which I made in the current year is 6 lakh rupees, guys, which is more than 5 lakh rupees. In such cases, I have to mention my PAN number. So if I'm making one FD of more than 50,000 rupees, or if I'm making multiple FDs during the year in such a way that the aggregate of the FDs is more than 5 lakh rupees, I have to mention my PAN number. Okay. Then when I'm purchasing a bank draft is nothing but a demand draft. So let's say like for example, I'm not sure whether you use this nowadays, but earlier when we had to pay any fees to ICAI, like exam fees or our student registration fees and all, we had to give a DD to ICAI. Now and all, I think you do online transfer, credit card, debit card, you use online itself, you fill the form. But earlier it had to be done physically. So what we used to do is, like for example, Chennai Nungampakkam, we have the branch. So near the branch itself, you have the HDFC bank, guys. So we used to go to the HDFC bank. We used to give them money. Okay, we used to give them cash. Like for example, let's say we have to pay exam fees of 1000 rupees. We'll give them 1000 rupees cash to the bank. Okay, and in return, the bank will give us a demand draft of 1000 rupees. So this is called as a bank draft or demand draft. So I'm going to the bank. I'm paying 1000 rupees to the bank in cash and I'm getting demand draft from the bank. So in this situation, if I'm paying to the bank more than 50,000 rupees in cash to get a demand draft, then we have to mention a PAN number. Similarly, if you want to purchase foreign currency, like let's say I want to go to the US, I want to take some dollars and go. So if let's say I go to a money changer, I'm giving him INR, I'm giving him cash more than 50,000 rupees and I'm asking him give me dollars in return. So here also I have to mention my PAN number. Then if I want to travel to a foreign country, let's say I want to go to the US and I want to buy tickets, okay, and I go to make my trip and I pay them in cash for the ticket more than 50,000 rupees. In return, they will give me ticket to US. So for that also I have to mention my PAN number. Then if you make a payment to a hotel, let's say you're staying in a hotel, you're staying for 4-5 days and the total bill of the hotel is more than 50,000 rupees. That if you're making payment in cash, you have to mention your PAN number. Then if you're going to a restaurant, let's say you took your entire team and went to a restaurant for dinner. Total bill was more than 50,000 rupees. If you're making the payment in cash of more than 50,000 rupees, you have to mention your PAN number. So in these 5 situations, guys, the transaction is more than 50,000 rupees and the mode of payment is cash. Understanding the transaction is more than 50,000 rupees and the mode of payment is cash, then in these 5 transactions, you have to mention your PAN number. Then after this, coming to my next 4 points. In these 4 points, guys, if the transaction is for more than 50,000, I don't care about the mode of payment. If the transaction is more than 50,000, you have to to mention your PAN number. If you're acquiring debentures, or if you're acquiring bonds, or if you're paying life insurance premium, or if you're making payment to mutual funds. In these four, if the value of the transaction is more than 50,000, doesn't matter what is the mode of payment, you have to mention your PAN. What are the four? You're acquiring debentures, you're acquiring bonds, or you're making payment to mutual fund or for life insurance premium. Okay. Then comes my next point. If you're going to sell or purchase securities other than shares, then if the transaction is more than 1 lakh, you have to mention your PAN. See, for debentures it is 50,000. For bonds it is 50,000. For mutual funds it is 50,000. For shares, unlisted shares, it is more than 1 lakh. Any other security which is not coming under any of these buckets, also if it is not shares, 1 lakh. Getting my point? So debentures, don't get confused. Debentures, it is still more than 50,000. Bonds, more than 50,000. Mutual funds, more than 50,000. For unlisted shares, if the transaction is more than 1 lakh. For other securities, all other securities other than shares, if the transaction is more than 1 lakh, then we have to quote our PAN. Okay. Then if you sell or buy any immovable property, if the value of the property is more than 10 lakh, then you have to quote your PAN. Value of the property is nothing but consideration or STV, whichever is higher. Remember, same language we use in 194 IA also. So if the consideration or STV, whichever is higher, if the higher number is more than 10 lakhs, then we have to quote our PAN. And any other goods, if we sell or if we buy, like for example, let's say you go to Chroma and you bought a lot of electrical appliances, total bill was more than 2 lakh rupees, they will ask you for PAN number. Okay guys, this was about who has to mention their PAN number in which situations. Now last 3 concepts only guys, listen to me. Defective return or incomplete return. If the assessing officer finds that my return is defective or it is incomplete, he will ask me to rectify the return within 15 days. If I do that, great. The return will become a valid return. You will treat it just like any other return now. I can revise it also later. It's like a proper legit return. But however, what will happen if I don't rectify within 15 days? If I don't rectify within 15 days, the return which I filed, that return will become invalid return. It will become void. It will be as if I never filed the return. So there will be no question of revising it later and all, because you will treat it as if I never even filed the return. But this is extreme consequence guys. So that is why we are also giving one power to the assessing officer, that listen assessing officer, if assessee is rectifying after 15 days, but if there is a justifiable reason for the delay, then it's okay. You please condone the delay and treat the return as valid return. So if you rectify it within 15 days, great. It's a valid return. I will treat it like any other return. If you don't rectify within 15 days, the return will become void. The return will become invalid. It will be as if you never filed the return. But there is one relief over here. If you are rectifying after 15 days, but if the AO thinks that there is a justifiable reason for the delay, the AO will condone the delay. Condone the delay means he will excuse the delay and he will let you revise, he will let you do the rectification after 15 days and it will still be a valid return only. Okay. To summarize, if you don't rectify within 15 days, there are 2 possibilities. Possibility number 1, even though you did not rectify within 15 days, it's okay. AO will condone the delay. AO will let you do the rectification after 15 days also, and we will treat it as if it is a valid return. The second possibility is AO is not willing to condone the delay. Then in that case, he will not allow rectification after 15 days. It will become an invalid return. It will be as if you never even filed the return. It will become void. Okay guys. Then comes the next concept, updated return. Section 139 subsection 8A. Very important because heavily amended for your examination guys. Section 139 subsection 8A, updated return. Now updated return is a favor which the Income Tax Act is doing on you. Like for example, let's say you did not file your ITR on time. It's okay, you can file ITR late. Belated return concept we have. But to file belated return, you have some time limit, right? You have time limit of 31st December 2026. You did not file your ITR on time. You did not file ITR within belated return time also. After this date, if you want to file ITR, then come to 139.80. Similarly, let's say you filed ITR. Now you want to revise it. Yes, you can revise. You have time limit. You have time till 31st December 26. But you did not revise within this date. You want to revise after this date. Come to 139.80. So basically, if you did not file your ITR on time and if you also did not file ITR within the belated return time limit, after that if you want to file ITR, come to 139.80. Similarly, if you want to revise your return after the time limit is over for revising, come to 139.80. So now in updated return, here also you should have some time limit, guys. Because can you come 10 years later also? Can you come 20 years later also? No, we have to put some time limit. The time limit is within 4 years from the end of the assessment year. I'll help you understand. Listen, let's talk about previous year 25-26, guys. Now for 25-26, if I want to file my ITR on time, okay, let's say my 139 date is 31st July 2026. If I was not able to file my ITR on time, then I can file belated ITR. So belated ITR, what will be my time limit? 31st December 2026. I did not file my ITR on time. I also did not file my ITR within this 31st December 26. Now after this, if I want to file my ITR, I have to come to 139.80. But I have to come to 139.80 within how much time? Within 4 years from the end of the assessment year. So previous year 25-26 means assessment year 26-27, guys. Assessment year 26-27, what is the end of the assessment year? If I want to file the updated ITR, then what is the end of the assessment year? 31st March 2027 plus 4 years will be 31st March 2031. So if I want to file updated ITR, that is, if I, understanding the point, right? If I did not file my ITR on time, also if I did not file it within belated ITR time, then I can come to 139.80, but here I have to come latest by 31st March 2031. Similarly, if I want to revise my return, I have to revise it by 31st December 26. If I don't revise by 31st December 36, if I want to revise after that date, okay fine, you can revise. Come to 139.80 and you can revise after 31st December 26 also, but come within 31st March 2031. So if you can come to 139.80, but please come within 4 years from the end of the assessment year. Okay guys, now listen. This is where you will feel how evil the income tax department is. The finance minister is saying, listen assessee, am I not doing a favor on you? I am letting you file the return even after belated return time limit is over. After that also I am letting you file the return. I am letting you revise the return even after the time limit is over. I am letting you revise the return. Big favor I am doing on you. You also do one favor on me. You do 2 favors on me. First favor, your return has to be in the favor of the government, not in your favor. That is, your return should not be a loss return. Your return should be an income return. In the return, if you declare loss, then how is it a benefit for the government? It will be a benefit for the government only if you declare income, heavy tax you pay, then only it will be a benefit for the government. So therefore, your updated return should not be a loss return. Then, because of updated return, your tax liability should increase. Because of updated return, if your tax liability is reducing, no, that will not be okay. See, we're doing a favor on you by letting you file updated return. Now, because of your updated return, the tax money which comes in for the government should increase. It should not decrease. So, because of your updated return, your tax liability should not reduce. Okay, then earlier I filed my return, for example, and in that return I was supposed to get refund of 1 lakh rupees. Now I am revising that return through updated return concept. I am revising the return. Now refund is becoming 1,20,000 rupees. No. This we will not allow. Because if this happens, it will be bad for the government. Because of updated return, your refund should reduce. It should not increase. Your refund should not increase. You're understanding, guys? So the Income Tax Act, the whole objective is, you're saying, we are doing one favor on you. Even after belated return time limit is over, we are still letting you file the return. Even though revised return time limit is over, even after that we are letting you revise the return. 4 years time we are giving you after the end of the assessment year. Such a big favor we are doing on you. You also do 2 favors on us. What is the first favor? The first favor, because of your return, the government should not be at a loss. So your return should not be a loss return. Your return should be an income return. Because of your return, because of the updated return, your income tax liability should increase. It should not decrease. Because of the updated return, your income tax refund should reduce. It should not increase. Okay. Then one more point. Let's say I had filed a loss return earlier. Okay. Earlier I had already filed my return. In that I had declared business loss of 1 lakh. Now I am revising that return through updated return. I am revising the return. Now I am saying no, it is not a loss. It's actually an income. It is 20,000 rupees income. So earlier I had declared a loss of 1 lakh. Earlier it was a loss return. But my updated return is an income return. Is this okay? Simple logic. Tell me, is it good for the government or not? Whether it is good for assessee or not, I don't care. Is it good for the government or not? Of course it is good for the government. It is definitely good for the government because number 1, your tax liability will increase. because it's now an income return. If a loss return is getting converted into an income return, that is of course going to be allowed. Okay guys, and for a year, updated return can be filed only once. This is of course for the purpose of ensuring that again and again you don't keep updating the return. For 1 year you can update the return only once. Okay, simple point guys. So concept you understood first of all, that concept number 1, that you did not file the return within belated return time limit also. You did not revise a return within revised return time limit also. After that, if you want to file the return, after that if you want to revise the return, then come to updated return, come to 139.80. Here you will get time limit of 4 years from the end of the assessment year. So till 31st March 2031 you can file the return, you can revise the return. But Income Tax Act is doing a favor on you. So you have to do 2 favors on the Income Tax Department. Favor number 1, your return, your updated return has to be in government's favor. Not in your favor, it has to be in government's favor. So it should not be a loss return. It should not be a case where your tax liability reduces. It should not be a case where your income tax refund increases. No. Because of updated return, your tax liability should increase. Because of updated return, your tax refund should decrease. Earlier return was loss return. Your updated return can be income return, allowed. Then for 1 year, you can file updated return only once. Okay. I was telling you 2 favors. This is the first favor, that your return has to be in the favor of the government and not in your favor. Now comes the second favor. Listen, assessee, we are doing such a big favor on you. We are letting you file the return even after belated return time limit. We are letting you revise a return even after revised return time limit. Now we also should get some benefit. Assessee will say, yes, you already took such a big favor. You are saying updated return should not be loss return. You are saying because of updated return, income tax liability should increase. Income tax refund should decrease. You've already taken so much. What more you want? Income Tax Department, the government is saying, we want one more benefit. This time we want money benefit. We want extra income tax. We want additional income tax. Understanding? Now notice how much additional income tax they want. If you file your updated return within 12 months from the end of the assessment year, that is, in our examination, our previous year is 25-26, our assessment year is 26-27. So end of the assessment year is 31st March 2027, plus 1 year will be 31st March 2028. So by 31st March 28, if you file the updated return, then you have to pay 25% additional income tax. Then if you file the updated return in the second year, that is, after 31st March 28, but within 31st March 29, then 50% additional income tax you'll have to pay. Then if you file your updated return in the third year, that is after 31st March 29, but within 31st March 2030, then you'll have to pay 60% additional income tax. Then if you file your updated return after 31st March 2030, you'll have to pay 70% additional income tax. Are you noticing? Atrocious, guys. 25%, 50%, 60%, 70%. This is the extra additional income tax. Now this 25%, 50%, 60%, 70% will be percentage of what? Percentage of your tax payable plus interest. Tax payable plus what interest? Your 234 ABC interest. So tax payable plus interest. Understanding? Okay. This was a discussion of updated return. Now comes your final concept, one last concept in your return of income chapter, tax return preparer, TRP. Now TRP is a person who will help you prepare your income tax return. The name itself very obvious, tax return preparer. He will help you in preparing your income tax return. Now who can be a TRP? Who can be a tax return preparer? You should be an individual and you must be having a bachelor degree. For example, you must be BCom or BEd. You must be having some bachelor degree, or you might be a CA Inter, CS Inter or CMA Inter pass out also. But however, if you're a chartered accountant, you're overqualified. You can't be TRP. If you're a practicing lawyer or if you're a bank officer in a bank where the assessee is having a bank account, then you cannot be a TRP. Okay. So who can be a TRP? You must be an individual. Either you must be having some bachelor degree or you must be a CA Inter, CMA Inter or CS Inter pass out. And then however, if you're a chartered accountant or if you're a practicing lawyer or if you're a bank officer in a bank where the assessee is having an account, then you cannot be a TRP. Okay guys. Now, which assessee can get the return filed through TRP? Everybody cannot get the return filed through TRP. Only if you are an individual or HUF and if you're a resident and 44AB tax audit is not applicable for you, only then you can go and get a return filed through TRP. So see, there's an assessee. He has to file income tax return. He is going to the TRP and asking the TRP, please help me file the return. Now the question is, who can this person be and who can this person be? So TRP, if you see this, we learned he should be having a bachelor degree, or he must be a CA inter, CMA inter, CS inter pass out. But he should not be a chartered accountant. He should not be a practicing lawyer. He should also not be a bank officer in the bank where the assessee has an account. Okay, so only this person who fulfills these conditions can be TRP, and of course he has to be an individual only. Now, who can be the assessee who is taking the help of TRP? That assessee has to fulfill three conditions, guys. Condition number one, the assessee has to be either an individual or a HUF, which means a company can never go to TRP. Then condition number two, this person has to be a resident. And condition number three, this person should be for this person, section 44AB tax audit should not be applicable. Only if you fulfill all these conditions, only then you can take the help of TRP to file your return. Okay. Then listen, can revised return be filed through TRP? Listen carefully, if your original return was filed through TRP, only then even your revised return has to be through TRP. Otherwise, revised return you have to do on your own. If I filed my original return on my own, for revised return alone, I can't go to TRP. But if I filed my original return through TRP, then for revised return also I can go to TRP. Okay guys, so revised return can be filed through TRP only if original return also was filed through TRP. That's all guys.